Hello, 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 hello. Mic check, mic check. Hello, hello. Hello, hello. Mic check, mic check.
Check one, two, hello, hello, check one, hello, check, check one, two, check, hello, check one, two, hello, check one. Check.
Hello, mic check, mic check. Hello, 1, 2, 3, 1, 2, 3. Hello, mic check, mic check, check. 1, 2, 3, 1, 2, 3, check. Hello, hello, mic check, check.
Hello, 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 hello.
Check one, two, hello, check, hello, check, hello, check, hello, check, hello, check, check one, two, hello. ये कैमरा थोड़ा पीछे आएगा check, hello, check, hello.
हाँ यस यस आ रहा है आ रहा है आ रहा है आ रहा है हेलो हेलो हेलो
Check one,
हेलो हेलो
check,
हेलो
check,
आ रहा है
one, two, hello,
हाँ यस आ रहा है आ रहा है आ रहा है हेलो हाँ यस यस आ रहा है
and your networks to see to whatever is transpires here is multiplied. Sir, the CUTS Institute for Regulation and Competition, the organizers of this panel discussion, is a not-for-profit and independent research and capacity building organization, which has been active in the areas of competition, regulation, and sustainable infrastructure, including PPPs. It was registered in 2008 as a registered society under the presidency of Dr. C. Rangarajan, who was then the chairman of the Prime Minister's Economic Advisory Council. What do? We assist multilateral and bilateral government and private agencies in knowledge creation as well as capacity building for achievement in policy formulation and also the projects they undertake. Our capabilities and contributions are now internationally acknowledged, and this is amply demonstrated by the mandates it has received from international organizations such as the UNCTAD, UNICEF, and the ADB. Today, we have an excellent panel on infrastructure development for SDGs, the role of private finance, where we will be talking about SDGs, their funding, role of banks, reformulating the infrastructure strategy, innovative infrastructure planning instruments, importance of PPPs, and other relevant issues. PPPs have become much more important now, in considering the fact that there is a shortage of finance globally, particularly from the governments, and therefore the capacity of governments to invest in infrastructure is reducing because of decrease in revenues, and therefore PPPs then become much more important. The importance of this panel can be directly linked to the ambitious commitment towards the Sustainable Development Goals that are to be achieved by 2030, and the dependence on sustainable and inclusive infrastructure development. According to an OECD report, more than 80% of the goals are linked directly or indirectly and or rely on the development of infrastructure of one form or the other. However, trillions of dollars are required in terms of new investments across the globe to meet these goals. That too at a time when developmental assistance across the world is declining and global growth decelerating. In addition to that, there is a much higher demand coming from infrastructure development projects. Thus, PPPs need to play a promising role in the market as a solution to overcome investment challenges and provide effective service delivery within the overall value for money context. However, we need to take people along because of the inherent doubts from the private sector. That still remains in the developing world a major issue. This needs to be buttressed by a proactive communication strategy. Here, let me take just one example of how people react to the entry of the private sector into the infrastructure sector. I was being driven in a taxi to the New Delhi airport when it was being operated by the government agency, the Airport Authority of India. There were some people, mainly staff of AAI, protesting against the transfer of the airport to GMR on a PPP basis. I asked the taxi driver about his qualms when he said that in future the GMR will not allow regular taxis to drop and pick up passengers from the airport because the airport is being sold to GMR. Well, that was his response. Common man, I'm surely educated to class 10 at least. That was his misperception on the basis of humors which float around these kind of issues. So I'm just giving one example of my own experience. I reassured him that the airport is not being sold to GMR, but is being handed over in a partnership mode to be run by them, and the property will remain that of the government, represented by the people of India, which includes you and me. And they cannot stop regular taxis from flying in the airport, which has not happened in any case. That's it. Of course, they use their own sort of arrangements to ensure that they maximize their revenues, whether it's operating taxis or shops or restaurants or what have you. But that is not the topic that I would like to talk about. There is an issue there that the Airport Economic Regulatory Authority, which is supposed to regulate all this, is not empowered to do all this. It only can regulate what is called the airside operations of the airports and not the land. Platform for corporate leaders, government, faculty, researchers, students, and other stakeholders to deliberate on issues of sustainable infrastructure development for SDGs. Also, and more importantly, this panel is a prelude to an international conference on infrastructure development for SDGs that we will be hosting in March 2023, and to a series of similar events which we can organize in the run-up to this major event that we're planning to do in March. Dr. Arvind Mayram, Chairman of the Governing Council herself, will introduce the panelists briefly and then invite them to make their opening remarks for about 10 minutes each. After this, we will have one round of questions and answers from amongst the panelists to make the panel more interesting and participative. Then we would open up the question and answer to the August gathering assembled here and virtually. At 4:30 p.m., we have a book release of select social sector case studies from India by Dr. Suman Berry, the Vice Chairman of Niti Aayog, and Dr. Patel, who's already with us. That will be followed by Dr. Berry's address, who will surely speak about the issues, particularly SDGs, which are Niti Aayog's terrain. With this, I would like to welcome all the panelists and participants for the panel discussion and look forward to a fruitful discussion for the next few hours. Over to you, Arvind.
Thank you, Pradeep. Thank you, Pradeep. First of all, my apologies because the delay was caused by a traffic jam that I got stuck in front of the IIC. But let me start quickly by introducing the panelists. We have a very eminent and a very relevant panel in the sense that the subject that we are going to discuss today, all of them in some way or the other have vast experience in addressing some of those issues. Dr. Urjit Patel is an eminent Indian economist who formerly served as the 24th governor of the RBI and a member of the G20 Financial Stability Board. He was earlier Deputy Governor RBI, looking after monetary policy, economic research, and financial markets. He also chaired the RBI committee to give recommendations development of infrastructure, credit rating scale, the credit enhancement fund, etc. She was the member secretary of the Kelkar Committee for Revitalizing PPPs. She has served as director on the boards of OVL, IIFCL, and IRFC, and as India's representative on G20's Infrastructure Working Group. Her areas of expertise include infrastructure, PPP, sustainable finance, foreign exchange management, and multilateral negotiations. Mr. Hun Kim is there. Hello, Hun. Good to see you. Mr. Hun Kim is currently the Director General, Social Infrastructure Department, AIIB. He leads the Social Infrastructure Department, investing in productive assets and services in the social sector, such as health and education. His department provides sovereign and non-sovereign loans for project and corporate finance, direct equity, and guarantees to support investment in developing member countries. Kim is a seasoned development professional who has built his skills and expertise throughout his long and successful career in the Asian Development Bank before joining AIIB, where he held senior positions such as Director General of South Asia region and ADB's country director for India. He holds a PhD in Applied and Resource Economics from University of Minnesota and an MA and BA in Economics from Yonsei University, Republic of Korea. Mr. Anuj Mehta was there. I could see him earlier.
He's there.
I think he's still there. Okay.
Sure.
He's just put the video off. All right. Anuj Mehta is currently country director, Thailand Resident Mission.
He's there.
Oh, he's there now? Okay.
He's there
Hi, Anuj.
from another window.
Okay. Anuj is currently country director, Thailand Resident Mission, and unit head of ADB's ASEAN Catalytic Green Finance Facility. Anuj leads the full range of work in the planning, implementation, and supervision of Thailand's resident missions, vision, goals, and strategies. He also leads the ASEAN Catalytic Green Finance Facility, a pioneering regional facility under the ASEAN Infrastructure Fund, aimed at green recovery in the region with 13 partners and $2 billion in financing support. Prior to his current role, he established and managed the Innovation Hub for Southeast Asia Regional Department of ADB, focusing on green and innovative finance. He has also previously led ADB's pioneering PPP initiatives in India. Prior to joining ADB, he was an investment banker and chartered accountant at JP Morgan Chase and PwC in London. Mr. Prasanna Srinivasan works as an independent advisor. Hello, Prasanna. And consultant in infrastructure and PPPs, and has been in project development, strategy, policy, and implementation with development finance institutions, including ADB, IDFC Foundation, UNCTAD, the Bill and Melinda Gates Foundation, CIRC, and the central and state governments. His over 35 years of experience include prior stints in project finance, capital restructuring, internal finance, audit and systems, corporate planning with transnationals for cross-border FDI into India, and not-for-profit sector in community-facing work, and in infrastructure companies such as INFS. His role in PPP's infrastructure areas has integrated his previous professional experience and shaped a strong people focus to sustainable infrastructure development goals. He's a graduate from IIM Ahmedabad. So without much ado, let us start our conversation. We are looking at the issue of financing the ambitious targets that the UN has set and member countries have accepted for climate mitigation, transition, etc. As most of the efforts at present, which include green bonds, sustainability bonds, transition bonds, etc., are focusing on increasing debt flow to meet this challenge, as much of the new infrastructure required to meet the challenges, as discussed at length in COP meetings, would be in the public sector. And this also includes the transition needs. The debt would necessarily have to be sovereign in nature. With rising public debt profiles in most countries, including the emerging market economies, especially post-COVID, debt sustainability is becoming another area of concern for global financial stability, as pointed out by the IMF. Therefore, there is an acute need to mobilize private finance. And today we are going to discuss what are the various ways in this private finance can be mobilized. There is a lot of liquidity internationally, but this liquidity needs to be channeled in a way that it reaches the emerging market and developing economies where the risk perception is higher and therefore the cost of finance also becomes much higher. One of the issues that we are facing today is the lack of real understanding about how much finance is really required, although we have various numbers from various sources. And this number is not really broken down into different sectors. And then with different sectors, they have not been now as yet linked to the NDCs, which the governments have accepted to be fulfilled by 2030. We are looking at an 8-year horizon. It is not a long-term horizon. And in this 8 years, if we need to achieve the nationally declared commitments under COP, then this kind of a mapping is very important and necessary. The other issue that the government of India is also going to raise in the forthcoming COP is the difficulty in really understanding how much of this, as we have discussed, is coming as debt, how much will it come at concessional debt, how much of it will come as grants, what will be the technology support which will be provided to the emerging market economies to be able to meet this transition into the green that we are looking at. So these issues are before us, and we are going to discuss this today amongst the panelists, and we will certainly also take questions from you. So the first panelist I will call upon to make his initial intervention is Dr. Urjit Patel. And I would certainly, with his very rich experience in managing monetary policy of one of the largest economies in the world, at a very difficult during a very difficult phase, we would like to see how he believes the financial system is, what is the depth in the financial system to be able to deal with the issues of green finance coming forward. Thank you.
Thank you, Dr. Myram, for that generous introduction. I'm also thankful to CIRC for inviting me. I hadn't met Pradeep Mehta for many, many years, and it was nice seeing him here today. So I will make my opening remarks in two bits. One, a slightly more general perspective on PPPs, perhaps just to get our basic model and understanding of it. As was mentioned, there are 17 SDG goals, so obviously no lack of ambition there. And over the next 2 weeks, goal number 13, which is climate action, will be the elephant in the room. Although I think a mammoth in the room is more pertinent because an elephant is too small. And the reason I say that is that in addition to the 8-year horizon that Dr. Myram mentioned, if you look at the 30-year horizon on the kinds of money that are being estimated, I think people should call them guesstimates rather than estimates, because I don't think they have been very carefully totted up, bottom up. I mean, one number I saw is $250 trillion now, not billion, $250 trillion, which is almost 9 trillion a year from now to 2050. But anyway, so why do we need private finance for SDGs, and why now? The vast infrastructure financing needs
exceed the fiscal capacity of governments and the balance sheets of multilateral development banks. The pandemic and the ongoing emergency relief expenditures, which in many countries are still continuing, have further squeezed the government's fiscal space for long-term infrastructure development. Notwithstanding the extensive private financing that can potentially be attracted, current participation of private capital in Asian infrastructure is quite low. Private financing is still predominantly provided by the banking sectors, with the large Asian institutional investor pool untapped. And in this space, India's InvITs are actually an exception. And the two people on either side of me did a lot of work. And there were times when I thought they were banging their heads against granite. And but persistence and perseverance has worked, and it is now accepted as a very normal asset in amongst many investors. So what role can private finance play? The contribution can be in both quantity and quality terms, and sometimes we forget the quality terms. It, of course, directly increases the volume of investment, filling the gap between infrastructure needs for SDGs and the limited public resources that could be mobilized to address such needs. However, private investors also bring agility in delivery and new approaches to finance the SDGs through infrastructure development. And that's the profit motive. Their value additions range from introducing new technologies that have passed the market test, advanced management experience to improve the efficiency of the sector, to human capital that are needed for capital investment and increasingly assets management as the initial investments become mature. What are the challenges of attracting private finance? So I'll break that up into two parts. One, pure financial sector issues, including risks, especially in the climate space, and the second, more general. And let me start with the more general. PPPs are commonly accepted solutions that would otherwise not meet the investment criteria of the private sector without cross subsidies in financing from the public sector. Despite the indispensable role of the private sector in financing some of these, effective collaboration between the public and private sectors can be challenging for various reasons. One is the unreliable mechanism to share risks and returns among different partners, relatively weak legal framework to ensure the smooth entry and, as importantly, phase out of private sector investment, lack of effective criteria and procedures to select PPP partners, inferior status of private sectors in negotiating a fair contract upfront and substantial costs of renegotiation. Now, it's interesting that there is a asymmetry in this between the developed and developing countries. In less developed countries where governments dominate the collaboration, whilst in developed economies, it is actually the opposite because of the superior information asymmetry of the private players in those countries. And the last reason is the weak institutional capacity. So let me now turn, with the chair's permission, to make a few comments on especially climate-related risks. Many of these risks are only realized in the medium term and beyond, compared to annual horizons for most other risks that the financial sector is used to weighing up, measuring, and provide for. The transition phases overall are highly uncertain. The taxonomy of risks in the area is insufficiently developed for coherent and consistent deployment. Tools and data for estimating these risks are unsatisfactory. In fact, data gaps are presently not appreciably better than in the past. The war in Europe will delay transition to a lower CO2 world. In the short term, energy security has come to dominate sustainability goals. For example, the comeback of coal and even the reopening of lignite mines, as also renewed prospecting by governments to develop nuclear. There is proliferation, fragmentation, and the almost inevitable concomitant confusion with multiple regulation setting committees internationally and associations. What is needed to price these risks? One is the definition of sustainability is essential. Globally, there are, and this is a number I found out in June, there are 26, and this is not a typo, taxonomies, principle-based and technical-based to price climate risks. Secondly, consistent disclosure regimes. Thirdly, auditors in this area have to be explicitly licensed, be independent, and should be capable. At the moment, they are not. Despite the IFRS, the capability and independence in this area is deemed to be low. While a comprehensive carbon tax is a first best solution for mitigating emissions, its likelihood seems at best to be low. The most natural global vehicle for introducing and shepherding a direct carbon tax is the G20. But as we know, the trust deficit amongst the largest emitters in the grouping is palpable for obvious reasons. Hence, a major initiative is unlikely. The questions for designing capital regulation for banks, which is the area that Dr. Ayaram had asked me to explicitly address in my opening remarks, in the context of climate risks, are drenched in uncertainty, abated by nonlinear complexity. Viz, what is a bank's direct and indirect exposure? What is the likely size of losses? When do losses materialize? What is the length of the stress period? How similar is it to past ones? Probably not much. And can they hedge and transfer risks? Future changes for bank capital on account of climate risks include the following choices. Systemic risk buffers, which basically means doing a Basel Plus, adjustment to capital adequacy ratio, large exposure limits, climate capital buffer to be adjusted to ratio of carbon intensity of GDP. Interestingly, lenders feel that transition funding for existing corporate entities was more important than greenfield green tech financing. Another neglected opportunity not talked about much is the greening of the agriculture sector. Regulators will be confronted with demand for green/discount regulatory standards, a mirror image of enhanced regulatory standards to account for CFRs. While introduction of discount regulatory standards for green finance was poo-pooed by many people, I suspect that policymakers and politicians confronted with higher interest rates and high public debt may find this cashless and hidden subsidy to boost financing for the green sector tempting. I will stop there and perhaps comment later on these. Thank you, Dr. Maya.
Thank you. I think this is set the tone quite well. The only one issue that I would wish you to speak on at this stage, and then we'll move forward, is with regard to the corporate bond market in India, especially because we find that it's very shallow, and to introduce green bond market in India is going to be even more difficult. Is there anything that the central bank can do to really start this particular aspect going?
So, my answer is that this should be done very cautiously, precisely because as a former regulator, I cannot endorse and will not endorse lower standards on anything. At the moment, there is also globally a large information asymmetry, and some of the issues are, let me just summarize them in this context. The greenwashing on account of the moral hazard because of the information asymmetry is significant, and there are large bandwagon effects. Some of you who would read the foreign financial press may have noticed at some points during this year, large fines were imposed in this context. Now, commercial sectors suffer from growing problems in this context. Likewise, development finance is also subject to the risk of greenwashing, and the ESG gaps exist quite widely. Accounting of ESG credentials for projects with blended financing, which is, of course, the basis on which you do green bond financing, could be a challenge. It needs to weigh the pros and cons of focusing on the direct impacts of assets acquired versus expanding the ESG credentials to participants in the financing, and how this can result in a mission creep amongst regulators and supervisors. Now, if broader credentials of those who issue bonds are to be taken into account, what data is available on which to make that call? I think that's also very important if we want to reduce the chances and create a reputation risk for unwanted greenwashing of bonds. Thank you.
Thank you very much. Let me now request Elizabeth to come in. UNECE is at the forefront of driving the PPP agenda globally. It has recently organized successfully UNECE Regional Forum on Climate Finance as part of COP27. This orientation towards green transition and sustainable infrastructure also involves a substantial public-private partnership, not only to achieve timely and efficient transition, but also to attract private finance. Elizabeth.
Many thanks, Dr. Mayaram, and let me start by thanking CATS and CICR for the invitation to UNECE to contribute. Can you hear me? I can hear you very well. See you very well.
Elizabeth, I'll just ask you to stop for a minute. There's some problem with the technical part. We are not being able to hear you. Is your mic mute for some reason?
No.
No.
Actually, I can hear.
Thank you. I can hear you as well.
I'm also back.
So in the online room, we can hear you.
Mute for some reason. We are not
In the main room, maybe not.
Can you bring the mic mute for some reason? Or
My mic is on.
Actually, I can hear.
Thank you.
Actually, I can hear.
Thank you. To my online colleagues, can you also hear lots of voices now? Yeah.
Yes, I do. A lot of noises, voices. Yeah.
There's a lot of interference, Elizabeth, as well. Now we lost it, I think. I can see and hear Hun, I think, but
Anuj, I can see and hear you well, but we cannot hear the room.
No, we can't hear the room now.
Yeah, I was also writing to the chat. Okay, maybe let's suggest that they continue with the speaker in the room until we have sorted it, no?
Yeah.
The online people can hear each other, exactly.
Very, actually, very clearly.
Very well, actually. No?
Almost the best, you know, the sound quality. Yeah. Yeah.
The online people can hear each other, exactly. The online people can hear each other, exactly.
So much muffled noises. Oh, it's gone now completely.
It's gonna complete. Why? Shall we suggest that they continue with the
Let me bring in here Sharmila. Sharmila, you were part of the Government of India team. क्यों नहीं जारी होगी? तो फिर आप क्यों हो रहा है ये सिस्टम? आपके पहली बार कर रहे हो क्या ये? Can you hear me? Anuj, can you hear me? Yeah, वो they can hear. सुनो, रुको.
कुछ बात करना है.
Don't touch anything.
Good afternoon, and Dr. Myram has asked me to speak specifically about the instruments already available for infrastructure finance and how they can be repurposed or handled for the SDGs and the NDCs of India. I'm going to talk a little bit about specifics because I think we're we have a tendency in infrastructure to talk big about larger things and we don't get down to the actual project financing. So I'm going to concentrate right now on what can be done immediately, because we need to have results immediately. Like Dr. Mairam had said, we're just 8 years away from 2030, which isn't too far away. The question that's often asked is the infrastructure instruments that we had devised in the late, I think between 2012 and 2016-17, do they need to be repurposed to attract green finance? They don't, because what are these instruments? They're basically financing vehicles for aggregating finance that is not really here. This is for finance that we wanted in here from patient investors like sovereign wealth funds, superannuation funds, insurance agencies, people like that. They have to be looked at from the point of view as what is their aim. They want to come in, they want to get returns. What has changed between the mid 2000, around 2012-13 to now is that a lot of these funds, their trustees have set different goals. The goals are possibly go into SDG related, ESG related investments. The purpose of the investment vehicles hasn't changed. It is the investors who are looking at something else. So what is the easiest thing to do? Look at the projects. That project that you're going to finance is the recipient of the money that is coming in. So what we need to do, and I'm talking of all EDMEs, including India, is we need to repurpose our projects. If you look at the national infrastructure pipeline, it's just a plethora of all the things that you could see in infrastructure in different sectors lumped together. We need to review that. You need to now position your projects as something that is going to help in our SDG, meeting our SDG commitments and the NDCs by 2030 by packaging them as sustainable instruments, sustainable projects which can receive such finance. Dr. Patel had spoken about greenwashing. One of the problems in infrastructure that I see, and I'm now dealing with a lot of projects, is this is one area in the world where you actually desperately need big government. Government is now sitting back all over the world and waiting for the private sector to take the initiative. We can't do that. We need standards for credibility, we need a taxonomy, and we need regulation. No government has stepped up. And in EDMEs, including India, our problem with not doing this immediately is that we will end up taking on the legacy standards that are set up by the EU. We don't want to dilute them in any way. We want all those standards ourselves, but there has to be a transition path for countries like India where we have a lot of development goals. So what is it that we can do immediately over here? The first thing that we need to do is see how we can delink E from the SG component. In infrastructure, we need to focus on E. There is a tendency now, especially from investors, to make it very fuzzy by including S and G. Right now, we don't have the luxury for doing that. Concentrate on E. This is not very popular in a lot of the NGO community when a lot of practitioners say this, but this is something we need because we need to focus on sustainable infrastructure, knowing that infrastructure by itself will never be gross zero. It will always be only net zero because the provision of any infrastructure asset means that we are hurting the environment. But in countries like India, we can't afford to not hurt the environment because we have development goals. Both Dr. Mairam and Dr. Patel had spoken about how the amount required is very fuzzy. We don't know. We hear numbers, huge numbers running into trillions. But countries like Indonesia are also now looking at NDCs in two ways. One is the NDCs that can be achieved by the country by itself. The other is the NDC that can be achieved with the advanced economies giving us funds for adaptation, for resilience, etc. I think the EDMEs need to come together and say this is a requirement because each day's delay means that the numbers of the trillions are multiplying. So this is something that we need to look at. When we do this, we have to also simultaneously see two things. That the VGF can be used for attracting green finance. One of the problems that we have been facing here, and I think Dr. Patel has spoken about it, is how do you protect lenders and bankers from the risks that you're seeing in climate finance? Climate finance is an area which is grayer than most areas in infrastructure, which is already gray, because A, we don't know when the risks are going to be realized. Two, we do not know what the technological changes are going to be in the next few years. Who knows? There may be some enormous technological change that we see, which is going to fix everything. Right now, we don't know. We do not invest enough in countries like India in R&D. Sustainable development requires a lot of cross-learning. We are not doing that just now. I heard that two countries, Israel and Singapore, in their major economic ministries, have climate scientists sitting there who point to the areas where R&D should be done. We need to look at the areas which are possibly going to cause disasters and invest in those. When we do this, we also have to look at the sustainability profile of a project. Sustainability in design, sustainability in the products that are used, sustainability in operations, and in the end, sustainability in the effects it has in the hinterland where an asset is provided. If we can look at the National Infrastructure Pipeline of India, pull out about 10 to 12 big projects, repurpose them and present them. And my originally parent department, the railways, is possibly one of the sectors which is poised very well for choosing for this. If you can achieve success in presenting them to investors, there's no dearth of investors who will come in. One of the questions that we are constantly asked in infrastructure development is, can we look at what are the problems that are affecting something that I'm in principle against, that is blended finance? Anuj Mehta, who will be speaking, he's one of the experts on blended finance. The reason I have always been against blended finance is this actually embodies a conflict of interest. And resolving the conflict of interest between the parties whose finances are being blended becomes again an area of great debate. And the EIB, the European Investment Bank, had recently said that the two reasons that blended finance isn't taking off as it should, one is that most public sector NDBs, etc., they prefer going in for clean grant financing rather than going in for these kind of concessional kind of financing. The second thing is investors don't find credible projects in terms of viability. So we come back to what Sir had asked me to look at, VGF. Can the VGF, which was one of the most popular attractions of PPPs in India, can the VGF be repurposed to help in blended finance? Yes, it can. Viability for such projects normally is about 2 to 5% of project cost. Can we look at VGF to come in to build in that liability? Sir, this is something that I think is of interest to you also. Simultaneously, if in a country like India, the credit enhancement fund that was announced, if that could actually hit the ground and start functioning, it was ready in 2017-18. I have no idea why it hasn't taken off. This would be an instrument where the government or the public sector could take the first loss guarantee, have a layered structure, then the banks, the investors, etc., would be the second layer. And that would also satisfy, I think, one of the risks that Dr. Patel had mentioned. How do the bankers see this? Because they're becoming risk averse in this. We need these things. We already have them. We need to get them working. The last thing I want to talk about a little is the Kelkar committee had given a set of recommendations. Dr. Mayram had asked me to look at whether some of those recommendations need to be looked at today. The only two recommendations which were actually implemented straight away, one was on ensuring that tolling on roads is done electronically. The second was that we need to monetize projects that are already functioning. Those two things have been taken up by the government. There were about 16 or 17 recommendations, if I recall, off the top of, yes, about 16 or 17. The two things that we need to look at right now is, one, we need to do skill development and capacity building, which is a term that is very misused among bankers, auditors, whom Dr. Patel had mentioned, and also in the agencies that review how government officers function. The Kelkar committee had given a set of recommendations on how officers shouldn't become wary of taking decisions and doing bold things. When we as a team working under Sir had looked at these instruments, we were very confident that they had our back. When you purpose investment vehicles, 4 out of 5 are going to fail. The fifth one, like an InvIT or a REIT, will take off. But we need to have the confidence that we can suggest these things and start moving pilots on them. How PPPs can take off again. There's been a lull. There's been a lot of bad press about PPPs, but PPPs are the only thing that can work when we have no money, and every day the money requirement is high. So in PPPs, we need to have the confidence that we can look at different models. When there are technological changes which we're not sure when they're going to come about, how do you design a project structure which can cater to huge technological changes in a long-term project, whereas the technological changes could be maybe in the medium term? There are models available already in the health sector when you have hospital and medical PPPs, where again, the instruments, those high CapEx instruments that we use for MRIs, etc., they keep improving every 2-3 years. Most models for PPPs already have that design structure. We need to look at that for climate resilient and adaptation finance. The other thing is, when you have the luxury of money which you can invest in a project, there's been a spate of articles on this. The tendency is to go in for big engineering, throw all the money and over design a project. We need to back off from that in a climate change kind of atmosphere. See whether you can build in adaptation and resilience in functioning projects. Take a series of small projects and then offer them as a whole for investors. If we could do this, and these possibly could be PPP projects that have already been built and need to be repurposed to deal with climate risks, I think we'll be in a position to use the instruments that we already have, including InvITs and even the municipal bonds for municipalities. That could take us a long way in achieving the results.
Thank you. What you're talking about is pooled investment. I mean, through pooled projects. You bundle the several projects and then invite investment.
Yes, sir, with a slight rider. Normally, when you go in for pooled investments, you have the same type of projects, and they are the standard projects where you're delivering assets. I'm talking of maybe a series of small things that are being done across a lot of projects, which, when they're aggregated, become large enough to invite investor investment. That's what I meant.
Thank you. Shall we try? Elizabeth, would you like to please come in? I hope we can hear you this time.
Let me try. Can you hear me? No. My online colleagues can hear me? With the sound behind, no? So maybe, shall we try another online colleague? Would maybe one of you wish to say something that we test whether it's better?
I could hear you really. Yeah, there's Hun. I could hear Hun very well, but and you, Elizabeth, but I'm not sure about the room and whether they can hear.
Okay, so maybe it's a problem between room and online, no? I keep speaking just to see whether something changes. And we watch the faces of speakers in the room, but it doesn't seem to be that they would be hearing, no?
No.
Okay, so they can hear me now on the screen. Reactivate my sound now. Let me unmute again now. I'm now unmuted on my side. The system tends to mute me again, but I'm now unmuted. I can, Mr. Kim seems to be able to hear me, yeah. The room is looking at the screen, so maybe they can hear me too. Maybe that was a yes, so let me, okay, excellent. So thank you for let me unmute myself again, yeah. And let me try. So many thanks to CATS and CR for inviting UNECE to join this discussion here today. I'm not gonna complicate things further by trying to show slides, but we still have some worrying faces on the screen. No. Sound is maybe too loud in the room or too noisy. Would you wish me to I speak with very low voice now, maybe if that helps. I unmute and I speak and we try again. Better now? Yes? Was this a yes? Wonderful. Okay, we try. Thank you. And thank you for the tech team for doing solving the situation. I'm not going to complicate our lives further by trying to show the slides. Maybe we just do with what we have right now. But to say here that it's great pleasure for UNECE to contribute to this discussion. And UNECE, as it was mentioned in the opening remarks, we have really been sort of at the forefront of developing tools for making PPPs work for the Sustainable Development Goals. Now, UNECE is the Economic Commission for Europe. It's one of the UN's regional economic commissions. I just keep speaking despite the boring faces, yeah. And so UNECE is one of the regional economic commissions of the United Nations, like ESCAP, for example, for the Pacific and Asia, like ECLAC or ECA. UNECE is the Economic Commission for Europe. However, amongst our membership, it's not only European, EU, EFTA countries, it's also a large number of emerging markets in Central Asia, Southern Caucasus, Western Balkan, and Eastern Europe. In my division, the Economic Cooperation and Trade Division, we work on trade, we work on innovation, and we work on infrastructure, financing, infrastructure investment, and that's where the question of PPPs, public-private partnerships, come in. Now, what has been the specific approach of UNECE with respect to public-private partnerships? Our question really is, how can we make PPPs work for the SDGs? And that question arises for several reasons. On the one hand, PPPs have been developed in developed countries as a financing and procurement tool, very much targeted to the needs of the high-income countries, with a clear focus on value for money and economic effectiveness. Over time, then, that tool was very much used in low and middle-income countries. However, the emphasis remained on value for money and economic effectiveness. And the question we posed in UNECE is, how does this tool need to be adjusted in a situation when financial money considerations are not the only ones, but when we need to bring the people on board, as it was said in the opening speech?
Yeah, please go ahead.
I continue. So how to bring people on board in the PPP context? This is really at the core of UNECE's work. And obviously, as a UN agency, we are very much guided by these 17 Sustainable Development Goals that have been mentioned also by some of our previous speakers, and particularly the Sustainable Development Goal 13 that also relates to our common ambition to fight climate change and ultimately achieve net zero at some point in time. Now, if we look at all these 17 development goals, they are very much interrelated to address social issues, they address environmental issues. So for us, it's a little bit difficult to just focus on the environment and maybe not focus on the social considerations, as the suggestion was made to here. We really try to look at it in a holistic, interdependent manner. And the 17 goals are really specified into 169 targets. I'd like to draw to your attention two goals that are specifically also related to PPPs. And you might wish to note that Sustainable Development Goal number 17 explicitly mentions PPPs as one avenue of achieving Agenda 2030 and the Sustainable Development Challenges. I'm not going to go into all these fuzzy guesstimates about how big the financing is. We had on the slides also provided some data, but maybe I jumped this. And just to reiterate what was said before by other speakers, it's really huge, these financing gaps. We are talking trillions, we are not talking billions. And question is sort of like how to pool both private and public sector for making that for closing that financing gap. Now, several speakers referred specifically to COP, and I think that's very timely as delegations are already traveling and arriving in Sharm el-Sheikh. And what UNECE also did is in the run-up to COP, we hosted one of our regional fora. Each regional economic commission hosted a regional forum, where we looked at really how can we work together to mobilize private financing for the climate transition. And that was an effort done together with the Egyptian presidency of COP and with the United Nations climate change high-level champions. They were the champions already for COP26, but also now COP27. And here in the sessions, it was really underscored the potential, the transformative potential of targeted financing for ambitious climate projects. And so what was done also in this context is that we developed a sort of like a pipeline of projects in different climate-related areas or sectors. And that included, for example, renewable energy production, energy storage, critical minerals, a key sort of like area that is essential for transitioning to the green energy, but also waste and how to deal with waste and digitalization, green hydrogen, green ammonia. So you could see that at this UNECE pre-COP forum, we also developed a pipeline of projects where financing can be attracted, and that pipeline of projects will be submitted to COP. And also the other regional economic commissions did that. So there will really be a huge, I would say, a very rich pipeline of projects from all over the world. Now, maybe coming back to the PPP approach that UNECE developed. In our quest to really make PPPs work for the SDGs, we looked also at some of the challenges, including the regulatory challenges that arose before. And we identified 5 challenges that the PPP system faced. And let me outline them to you. One is how to increase access to essential services. Yeah, so that really means that we need to make PPPs work for the socially and economically vulnerable. And in our PPP guidelines, that is sort of like one core area of our work. The second challenge we identified and to which our PPP guidelines and tools respond is how to improve the economic effectiveness, specifically also from the angle of including women empowerment and fiscal sustainability. So here that really looks also at the sort of like fiscal sustainability of projects so that the projects can have their transformative impact. The third challenge we identified was to ensure environmental sustainability and also environmental resilience, and that's where the climate issue comes in. So our PPP guidelines really specifically target also the environmental sustainability. And the fourth challenge we identified is the importance of promoting replicability and the development of further projects. So if we want to achieve that transformative impact that is needed, it cannot be small-scale individual projects, each identified for a new situation, but we really need to have sort of an approach that is replicable and that can be scaled up. And the fifth challenge that we identified in our PPP guidelines is how to involve all stakeholders. So that also implies integrating special groups who maybe have a limited role today and where it's very important to bring them on board. So to summarize, UNECE's approach to PPPs is on the one hand directed at meeting all the SDGs in their entirety, economic, environmental, and social. And climate is one of them. We have recently focused on climate. And secondly, in our PPP guidelines and tools, we really identified 5 challenges, and we give specific guidance and options how to meet them. That would be access to essential services, economic effectiveness, environmental sustainability, replicability, and involvement of stakeholders. Now, to close, these guidelines, they are not developed by the UNECE Secretariat. UNECE guidelines and tools are developed by a large number of experts all around the world. And importantly, they are also adopted in our normative machinery. So it's actually our member states, our governments, who approve the different guidelines and normative instruments. And one of the most recent tools that our membership has adopted is the so-called evaluation methodology for PPP projects. And that is basically an assessment tool where those who put together a project can score their project against a large number of indicators that are developed in our PPP guidelines. So that assessment tool is very much also a self-assessment, so project developers can do that for themselves. And it is aimed to sort of like help ensure that projects are sort of doing a better job in terms of meeting the SDGs. So let me for now stop here. I cannot say how much of my intervention came across, but essence is that UNECE's work on PPP is really aimed at meeting the SDGs, Agenda 2030 in its entirety, that we recently have focused on preparations for COP and developed a pipeline of projects. And thirdly, that our most recent tool is a self-assessment methodology that is aimed at empowering project developers to self-score, to self-assess their projects so that these projects are more promising in terms of offering an effective contribution to the SDGs. Let me stop here and hand over the floor and we see how we take it from there. Thank you.
So we were able to overcome the challenge. So I'd like to ask you one question, which is UNCTAD has regularly undertaken policy reviews, investment policy reviews, as you're aware. One of the big challenges is that all over the emerging markets and developing countries, there is not much clarity about policies and regulations that would promote PPPs. They are more attuned to traditional kind of funding for infrastructure, but not through PPP structures. Does UNECE intend doing these kind of policy reviews, which would help the countries to be able to identify those regulatory gaps, and then which would facilitate PPPs in this area of SDGs?
How we connect UNECE's work on PPP, my current post with UNCTAD's work on PPPs, my previous post. I think UNCTAD, and I cannot speak on behalf of UNCTAD, but UNCTAD did an amazing job always in documenting the trends in investment policies. And as you have emphasized, there are monitors and lots of interesting documents coming out from UNCTAD. Now, and UNCTAD surely also is a development agency that supports countries in providing advice on laws and regulations. Now, in UNECE, we are not having such a large research stream as UNCTAD, so we don't track policies globally or in the region. However, what we very much do is we work with individual beneficiary countries, assessing their laws and regulations and helping them sort of like orient them towards the PPP approach. So amongst others, we do that in Central Asia. The team is just about to travel to Uzbekistan and work with Uzbek government on their investment approach and PPP approach. We also do it in Eastern Europe, and speakers have referred before to the war in Ukraine already. So for example, we are also working with Ukraine on the regulatory framework of how to ensure that PPPs in the reconstruction effort are sort of like targeted to the SDGs. So indeed, UNECE has a quite comprehensive capacity building program that supports member states in their development of their laws and regulations, and also in the development of individual project design. Now, maybe one qualifying factor that for UNECE, our beneficiary countries are our 17 beneficiary countries in Central Asia, Southern Caucasus, Eastern Europe, and Western Balkan. So as a regional economic commission, we cannot, in terms of capacity building, sort of like serve the globe. But I can assure you that we are joining hands with the other regional economic commissions, with ECLAC, ECE, ESCAP, and ESQA, and that UNECE's People First or PPP approach for the SDGs is very much also being picked up by these other regional economic commissions. Back to you, Aaron.
Thank you. I'll now request Mr. Hun Kim to make his intervention, especially because Asia Infrastructure Investment Bank is a new entrant into the development finance space. And you have, interestingly, a very specific department which looks after social infrastructure, which I don't think we have in ADB or World Bank, specifically looking after social infrastructure financing. So I'd request you to come in and make your intervention on the issues that you are facing at the moment in terms of pushing infrastructure finance, especially into the green infrastructure area, social sector area.
Thank you. And also, it is really wonderful to see you again, Dr. Mayram. And I'd like to thank you for inviting me to participate in this very meaningful discussion. And I'm also glad to see and join AIB's Vice President, Dr. Urjit Patel, this afternoon, and who is my boss in AIB. And hello to the colleagues in the panel and audience. At the outset, I'd like to apologize for joining the meeting online only. Actually, I'm joining the discussion from Beijing, China, and I hope to travel to India early next year. And India being definitely very important, but still untapped market in my area, which is social infrastructure. Now, I have 3 quick points to make this afternoon, and my remark is focusing on financing only, because regarding the green agenda and other there may be regulatory issues, Dr. Urjit Patel and other speakers have already provided some covered and provided a comprehensive picture on that. So, but I can answer questions on green, although. First, I'd like to touch upon the role of MDBs in the current and unfolding economic and financial environment. Dr. Mayram, you said at the moment. I think this at the moment is very important. During the pandemic, there was a plenty of liquidity, but now you can see, the money is disappearing quickly in the system. And we can say health crisis is now contained, but it seems that liquidity and financial crisis is looming in many countries. The question now is how we can do projects at all under the current circumstance. As a matter of fact, when liquidity in the market and in the government hands are very tight, MDBs have a certain role to play, especially when even bankable projects are no longer bankable because of the market liquidity. In AIB, we have unique in the sense we have no concessional resources. So even in social infrastructure, half of my investments are in the private sector. And one of my main lines of work is to provide project finance loans to the sponsors of PPP and PFI projects. And also I make corporate loans and provide guarantees on loan and bonds, both sovereign and non-sovereign. Just for instance, I'm currently negotiating a sovereign guarantee to a syndicated loan facility for a sovereign health financing, and also a non-sovereign guarantee to a bank loan. Again, this is a syndicated bank loan to a Chinese education group. And both of these are in dollars. And I have also provided corporate loans to pharmaceutical companies in China, in Asia. In social infrastructure, I also, in addition to, we do a lot hospital infrastructure, and also emerging new sectors are like health diagnostics and local manufacturing of healthcare product and others, digital health and so on. And also interestingly, we really see proposals for PPP in education in Central Asia and Middle East. So those are the markets. And now I like to discuss a little more on the immediate challenges in the current economic situation. And let me start by saying that the PPP projects I support mostly depend on the availability payments. I remember in India, we used to call it annuity or so on, but generally we call it availability payment, which are guaranteed and paid by the government. And the payment is a good payment because it's usually indexed with exchange rate and inflation. And now you can see that there will be less PPP project in this modality because government, after the crisis, the pandemic, have no fiscal space to provide the availability payments. And even the commitments already made may face the higher risk. For instance, I'm currently working on several PPP hospital projects in Turkey and in Central Asia. And already the financial closure is becoming increasingly more challenging with the rising credit risk. I have to ask them the higher pricing, and also deteriorating macroeconomic environments, meaning that the downgrade of sovereign rating, or again, the cost is higher. So on the other hand, the current challenges actually motivate us, especially at the MDB, to think if MDBs can work on the public sector side of PPP project. BGF is one option, but I like to just float one idea. Whether public sector can provide public sector loans for the government to make availability payments. Because availability payments is spread out more than 10 years, and traditional MDB project loans have no more than 5-year disbursement period. So we need an innovative structure here. So one idea is that if we can pool several PPP projects together and create a platform, it may be possible to establish a multi-tranche kind of financing. Every 5 years, we public sector loan, and that platform, but will last many 20 years plus. So it's a multi-tranche kind of financing mechanism. Maybe can be considered on the public sector side. So having said that, on the other hand, the PPP similar structure, PPP holding company is already used by private sector sponsors, and whose revenue flows depend on the future dividends from the underlying PPP asset. Actually, as a matter of fact, I'm working on what I call the second generation of PPP project, a platform project, which depends upon the cash flow from the underlying PPP asset. Now, a little more on the credit risk. Clearly, I can see with the especially declining asset prices, now the sponsors have a weaker balance sheet, and they have less borrowing headroom. And as I said, loans are priced more expensive. Now, under such environment, even MDBs like us, we tend to limit our lending now only to our top-rated sponsors. And smaller second-tier sponsors with even bankable projects may be marginalized. We can see they are marginalized under circumstances. So again, I ask, but the government may play a more proactive role as an intermediary by borrowing on their behalf, using government's credit, and channel the money through some kind of a wholesale facility. So overall, MDBs, I think, will continue to lend a private sector, and we may even increase its support. But I think the government need to play a role to credit, especially credit enhancement, give more comfort to the MDBs so that we can lend and we can investment. My final point is a little bit on the AIB side, AIB operations. And AIB, Dr. Myron, as you said, we are a young bank. The biggest the operational challenge for us is to build investment pipeline, both for sovereign and non-sovereign projects. And Dr. Patel will assure you, confirm you that AIB has more than enough lending headroom. We have we have a lot of lending headroom to invest. And AIB is very unique in having a corporate target to achieve 50-50 between sovereign and non-sovereign investment. For instance, in ADB, private sector is still portfolio of about 10% in the total portfolio. But imagine AIB's target is 50%. So this means that AIB will more aggressively with private sector, almost at the level of EBRD and IFC, while we do sovereign lending also. But the challenge is for us is being a small and new bank, AIB does not have a legacy client base. We do not really have a financial advisory function, and we are short of a project development facility. So we do project in many different ways. And I like to also do the same in India. And I need help from the government and business people. So we either join club deals with other MDBs and commercial banks, and also financial advisors of different sponsors actually reach out to me for asking me to express interest in debt financing for PPP projects prior to bidding. And also, I myself also directly contact EPC contractors and reputable sponsors for financing opportunities. So my personal experience last 2 years include exploring all these opportunities, but I have not been very successful in India. So I hope one of my motivation today is to share this opportunity with the stakeholders in India, so AIB can also contribute to the more. As mentioned, I worked for ADB many years before joining AIB, but I can say that AIB could be faster, and AIB could be more flexible, and AIB can combine both sovereign and non-sovereign within the same department. So I myself can do sovereign and non-sovereign at the same time. On the other hand, the weaker part of AIB is actually AIB is a lack of capacity building support, or we are still not yet fully equipped to do knowledge creation activities. So that is why AIB so far on the sovereign side co-finance a lot of projects with ADB and the World Bank, and do non-sovereign on our own. And having said that, we are also very eager to expand our sovereign operation, and I like to seek the support and the interest from the panel and the stakeholders. So thank you very much.
Thank you very much, Hun. It was reassuring that you are going to be scaling up your operations in India, which will be very welcome. But I have one question to ask, which is you mentioned about the your suggestion that government should borrow and then lend to private sector, which from your perspective becomes much easier when dealing with PPPs. Now, one of the biggest challenges that most countries, including India, are facing is the issue of fiscal stability. And fiscal deficits are very high. In the case of India, combined deficit of the states and the central government would be close to 10% of the GDP. And this is certainly something which IMF is flagging as a great danger to fiscal stability. So the borrowing headroom for the sovereign is shrinking, and therefore, is AIB open to looking at a new taxonomy where you do not look at projects purely as public, lending as public lending and private lending, but you can also have, as you mentioned, in case of annuities where government is guaranteeing payments, where PPPs can be treated as quasi-sovereign lending, because there is a backing of the government or a guarantee of backstopping of the government. There are also, the legal framework. For instance, in India, if you are lending to a PPP projects, for instance, in road sector, the concession agreement itself states that in case of private sector default, the government pays the entire debt due, which is actually guaranteeing the payment of the debt, which has been contracted by the private sector for the project. So which becomes kind of a tacit guarantee by the government, in which case should such a lending be treated as private lending? Because at the moment, globally, financial sector looks at private lending and public lending or sovereign lending. But it is not looking at this in-between lending where the lending is to the private sector, but the repayment is guaranteed by the government or the sovereign. So do you have some thinking on it? And this question also I would request Anuj to take on when he's speaking, because he's now doing green finance with the Asian Development Bank. And this question will also arise in terms of the green bonds that the multilaterals wish to float for lending to projects in their member countries. Hun.
Actually, you have said all by yourself, but let me just add a couple of points. My point number one is it will be, we all already know it will be very, very difficult because there'll be no debt. There'll be no project finance debt. It's becoming already too expensive and it's disappearing from commercial project finance debt provider. And now Dr. Mariam, as you said, actually I argue a lot with my own credit department within AIB. I say this so-called PPP project, as you mentioned, is MDB project. It's actually all quasi-sovereign because it is all backstop. Without that, it's a guaranteed availability payments are mostly guaranteed, even are protected from macroeconomic risk. But without that, it will be very difficult to take a PPP project purely based on. Of course, we take also purely based on sponsors' credit. So what I'm saying is now that money is disappearing on both sides. So especially on the government side, there are many bankable projects. Maybe there have to be consolidated effort to continue the bankable project by at least maintain certain liquidity, and the sovereign borrowing, whether it can be used to maybe has a higher leverage effect in that sense. If the government still has to borrow, even the fiscal space is tight, but still what I'm saying is working with MDB, and there'll be more higher leverage and more efficient operation of doing so. But anyway, I mean, these are also the field that my VP may have a strong view on it. So yeah, so I'll just stop here.
Thank you. Let me bring Anuj in now at this point. Anuj, you've done some fascinating work in the area of GSS Plus, as you call it, and the ASEAN Catalytic Green Facility. We would like to hear from you how this financing of green infrastructure is being expanding in the ASEAN, and what kind of lessons can be learned in this region, the South Asian region that we are in.
Thank you very much, sir. I hope you can hear me there. Okay, good.
Yes.
I think you can. Right. So maybe I'll just, firstly, thank you very much for having me on in this very distinguished panel, including with my own former bosses, such as Hun Kim, who I'm glad to see here too. And maybe apologies also that I'm not there in person, last minute change in schedule, as you know. On the green finance area, before I just talk about, the two specific initiatives you mentioned, stepping back a little bit, from Southeast Asia, the ASEAN perspective, maybe just to set 2 or 3 numbers in context. So I always use this to really talk about what I'll talk about in a second, the facilities and the solutions. But the challenge is, if I talk about the 3 or 4 off-track things in the whole world of climate, one is that we are completely on track for a 2+ degree rise at the moment by the end of the century, global temperature rise. Even if the net zero emission pledges actually are happening, we are talking about 2.2 degrees. And so you need to do a lot more to be able to stay under the 2. And that's the first trigger. So off track in terms of climate and global temperature rise. Number 2, off track in terms of achievement of several of the SDGs, 17 SDGs Dr. Patel mentioned earlier. And especially if you take several of those in water, healthcare, inclusive access to energy, very, very much off track in many countries. Number 3, urbanization. Very much on track to have a huge increase of people living in urban areas, maybe 2.7 billion people in urban Asia by 2030. A huge issue in terms of densification and therefore acceleration of the issues of water use, climate impacts. And then last, very much off track for 1.7 trillion per year. So in Asia, we always say we need 1.7 trillion a year for climate resilient infrastructure. And so when you look at those, those 3 or 4 numbers I've just sort of thrown out, the challenges are immense for climate finance. Secondly, maybe I'll talk about an anecdote. So I've been working in Southeast Asia now since 2015, and I spent a large part of those years pitching green finance facilities in a number of different countries. So I saw at the same time the development of, let's say, a climate project where we were developing a green transport project. Which went through very fast, and then a green finance facility, a leverage facility. I won't use the blended word, but I'll come back to that in a second. And the facility where we created something and put it in a country, Indonesia in this case, has led to basically 150 million from ADB, basically catalyzing almost 600,000 worth of dollars into projects, and especially about 500,000 tons per annum of greenhouse gas reduction. So, if you bring all of that together, the single biggest challenge I think we have is scale. So I think the thing that needs to be mentioned quite explicitly is how do we deal with the issue of mobilizing climate finance in our part of the world, Southeast Asia, especially in this case, in the time available. So it's not a question of doing an individual project or 2 or 10, but about catalyzing $6 or $7 of private capital for every dollar of public sector funds, whether it comes from the government or a multilateral is a separate issue. So in that context, basically, we've been focusing on these two things, which I'll mention now. One is the ASEAN Green Facility, and it's the only regionally owned green finance facility, I think, in the world, which is managed by ADB. A team of my team in Manila manages that. The ACGF is basically a de-risking fund. Now, why that's critical is the 2 or 3 issues that several speakers spoke about today. Project pipelines. There isn't a pipeline of bankable projects available, number one. So that's the finance angle. Secondly, climate indicators, despite all the discussions, when you start going down to city level, SOE level, and let's forget about renewable energy for a second, but let's go into water, transport, healthcare. There just aren't projects available, and they're not the understanding by local government, officials many times, in terms of what green is, what's an indicator, what's a taxonomy, is sorely missing. So that deadly combination of a lack of innovative financing models, as well as technically understanding what green or climate indicators are, is a real issue for why bankable projects are not happening. So therefore, what seems to work very well is the creation of these de-risking facilities, and that's what ACGF is. So it's now a $2 billion facility with 13 partners, which includes the Green Climate Fund and the UK government most recently. And that includes almost $30 to $40 million of pure project preparation. Now, why I'm stressing on this is having a pure PDF on its own has been tried many times, and it may lead to projects, it may not. Those projects may get picked up, may not. Having a pure concessional fund, and we've got several of these sitting in our part of the world, which says apply and we'll give you funds for a green project, is well and good, but they don't know how to create projects. So what ACGF does is, together, it says that we will help develop projects in certain sectors which are seen as dark green. Now we're going beyond green into dark green with greater impacts. And we have concessional or incentive funds available if basically we can satisfy those projects being green, bankable, and able to mobilize private capital. And that's basically how ACGF is moving very well, with some 30, 35 projects in the pipeline now, which we are both developing, financing, providing technical assistance to. The second issue, which I'll just talk about perhaps in closing, is bonds. So if you look at the number I mentioned earlier, 1.7 trillion per annum needed in Asia Pacific in climate infrastructure, I think last year, the green, social, sustainable bonds market was something like 70 billion or something like that. In India, I think it was $8 billion of green social bonds issued. In ASEAN, it was about 24 billion. How do we scale up the issuance of green bonds, not from simply the sovereign governments, but SOEs and cities? It's a major challenge, major challenge. And so what we are trying to do now is scale up bond issuances across Southeast Asia with the launch of this initiative, which says not just capacity building, but development of the bond systems. So the financial management systems, credit rating, and then issuance of a bond. In closing, I'll give two examples. In Thailand, we put together a very small technical assistance, maybe about $70,000 to $100,000, to help the government of Thailand issue a sustainability bond after COVID, the first one in the world. That one little technical assistance has led to almost 6 billion worth of funds flowing into Thailand for basically the metro project and a social project over there. And the other example is SDG Indonesia 1, which is a green finance facility leveraging 4 or 5 times private capital. And I think is what I would say is probably the message for Southeast Asia, which may be useful for the other parts of the world, which is national governments should create green transition or de-risking vehicles or facilities, which very smartly use the concessional funds, maybe not as grants, but maybe as revolving funds, de-risking issues like you were mentioning in terms of exit guarantees, etc. And that is what I would call better leveraging of public money. Blended has, of course, got a certain definition according to the OECD and IFC. So I tend to use more leveraging. What can we do to leverage money to transition a project from non-bankability to bankability and climate indicators, and therefore that has an impact. And that's basically what ACGF is trying to do. And let me stop there for now. Thank you very much. Back to you.
Thank you, Anuj. That was very interesting. You have spoken a lot about the green bonds part, but I was wondering whether when you are talking about this capacity building and also the project development finance that you, I mean, the grants that you have as for preparing the bonds issuances, have you also looked at the possibility of reworking within the ADB, as I had mentioned earlier when I was speaking to Hun, the entire perspective on how sovereign, non-sovereign, and quasi-sovereign should be looked at in terms of lending, so that much greater money can flow into the projects which are public projects, which are implemented by the private sector through private finance, let me say quasi-public finance, and which then eases the issue of these deficits that the countries are facing.
Okay. I hope you can hear me. One second. Right. I hope you can hear me. I think that's a super interesting issue. So maybe sort of I'll just mention two things. One is private sector. So ADB's private sector arm, PSOD, lending to basically possibly government projects, so PPPs, concessions, or even SOEs, is of course something that we've been trying to develop for a while. Now, what we're doing at the moment is a closer collaboration or integration between public and private sectors, where the public sector side is trying to do much more on the development of the projects upstream, and I mean including financial structuring. This includes putting in place the mechanisms which may make a project a little bit more bankable, doing the early stage structuring, etc. And then when the financing aspect becomes clear in terms of how much the project can sustain at a certain price point, that would then go to the private sector. And if it needs a certain amount of transition finance, which makes it more bankable, that would come from a concessional source, namely the sovereign side. Now, the idea of the public sector lending to a project without a sovereign guarantee, which is I think where you were leaning towards, is also something which is not unexplored. So if you look back at those projects that we were doing even in India itself, Bangalore Metro, Pimpri, Nagpur Water, that was essentially a sort of a model where the public sector side was assessing and then actually approved lending from the public sector to a project which was essentially a government-owned project at a price point which reflected the risk of the project, except that the risk was made better and therefore the pricing, because the structure of the government coming in a sort of a guarantee for certain payments was bought in through an escrow account. And now that's your sort of classic project finance structuring, which is sort of leaning towards what you were mentioning in your earlier points. I think that's sort of a holy grail where increasingly we are trying to look for projects under what we are now calling this One ADB Green Blue initiative, which is try to develop projects together in terms of TA structuring using some of our TA funds from the public sector side, help develop a mechanism where you could have the government guarantee coming in, whether for a revenue, for an exit guarantee for an investor, or some other lockbox sort of a structure, and then examine whether the financing should come from a blend of public and private sector capital, perhaps. I think that's where we are going. The whole ACGF ethos is actually all of that, which is saying, do we need to use some of our, really concessional money, from the UK government or Green Climate Fund, put it through the public sector and have the rest of the money coming in, directly to a project, but buoyed basically by some of those guarantees from the government. I don't know if that helps her, but that's sort of the model that we're trying to do on a project basis, rather than say that this is a sort of a new operations memorandum, if you like, for, a whole department. It's sort of a project by project approach. Let me stop there.
Thank you. That's the kind of a creeping reform, as we call it, right? But one issue, interesting thing, I think I would like you to also reflect upon before we go to the next speaker, is about you spoke about green financial institutions. Can you speak a little more, which you said are green catalytic financial vehicles, some such thing I had read in one of your presentations or papers. Can you speak a little more about that?
Good. They've allowed me to unmute myself. Right. Okay. So sorry for the lag. The idea of basically national green transition or de-risking vehicles is probably the most critical thing. And why do I say that? As multilaterals, we can do a certain amount of work with projects, but the idea of having development finance institutions or SPVs or facilities in country armed with basically funds which can be used smartly, as I was saying earlier, public sector funds to de-risk projects means that they're closer to the ground. And the example of that is a facility that was set up in Indonesia with our support called SDG Indonesia 1. So it's the National Development Finance Institution of Indonesia. They've been tasked with trying to accelerate finance into the SDGs in Indonesia. And we said, look, climate basically cuts across 6 or 7 SDGs at least. So we set up a green facility there. And there we basically said the public sector money comes to you, Development Finance Institution for Indonesia, and the funds should be used in this way for de-risking with 3 options. And then we helped put a little PDF in place, Project Development Fund. And now we are identifying, I think, around 15 to 20 projects, which that facility will then take forward and provide funding to. So it's a bit of a twist on what we used to call a financial intermediary loan, but with a very specific use for those funds as a de-risking, de-risking mechanisms. Now, I would argue that that would probably be the way to go forward at a sovereign level in each country, to have a net zero fund, or but basically sort of aimed at de-risking. I would argue that it could even go a little further into specific sectors. So national de-risking fund for urban or biodiversity. And we are experimenting at the moment with 3 of those. Oceans health, so there's something we're developing on that as a national facility, a biodiversity fund, and there is discussions also going on about how we can create something for EVs. So, that's sort of the idea, transition facilities at a national government level. And, if I may say in parting that this is, not far, it's a bit of a takeoff on the work that, you and Sharmila had been doing with the PPP window, which is viability gap funds. And we are sort of saying, link those funds to climate impacts and de-risking instruments, whether it's exit guarantees or even supporting things like annuity payments. I'll stop there.
Thank you. That's very interesting. So now I would turn to Prasanna. Prasanna, you have done a lot of work. In fact, I've had the privilege of working with you for a very long time now. And on the side of PPPs specifically, but also in urban projects, in the SDG related projects, you've done a lot of work with state governments like Tamil Nadu and some other state governments. May I request you to come in and make your intervention, please?
Thanks a lot, Dr. Mayram. It's been quite interesting and fascinating listening to all the previous panelists. So I'll try to restrict myself to things that may add on to the content of the discussion. They're a bit by way of both observation as well as queries, which I'd request the panelists to jump in and respond to. About a week ago, when preparing for this session, I took a look at how many governments in the world actually run a budget surplus. Do they have money to kind of throw around? And a list of 30 countries showed up. Leading the list with a pretty substantial sounding number was a little island called Tuvalu. It's somewhere in the intersect of the international dateline. The dateline gets skewed at one point, like somebody used a serrated ruler. And so somewhere around there is Tuvalu. It's near the equator in international dateline. It has a population of about 12,000. So not a big island. I'm pretty sure when they consider many of the issues on climate and economy and so on, the sums needed are pretty large. The limited point I want to make is, besides island republics and a few, city-state kind of ventures, typically some which are very oil-rich or energy-rich and so on, most governments don't have tons of money, especially the ones in developing countries, including our own, because there are many competing needs. I mean, we've just gone through COVID. We're coming up now with inflation-related issues and, shoring up the foreign currency and this, that, the other. And priorities tend to get determined by what's happening at the moment for the elected or the government of the time. So one is, let's just safely assume that the money to enable infrastructure as an as a general enabler of water, sanitation, and so on, it's not going to come easily from the government. You add on these 9 trillion a year that Dr. Patel mentioned, you can look at it, say, look, this is impossible. So might as well just have a good time and watch everything go to hell. Luckily, most of us don't do that, which is why we have our jobs as well. But I think with the belief that you can do a few things that can help try to chip away at this problem. I want to touch on a few. One of the biggest problems within the infrastructure sectors, because of historically how it's evolved as something that the government does, is there is very limited capacity on both sides of the track, both in terms of government's own ability to sense what is possible with outside support and assistance of various kinds, besides contracting. And secondly, within the private sector to say, why should I take something that's extremely difficult on as a project? Mr. Hankim and Anuj have at times, if you recollect, Dr. Maram, we've been involved with cooking up projects in India for PPPs and infrastructure. And this has entailed actually doing a lot of ideation collectively with a lot of people, including industry, and cooking up a project and then actually defining it enough to be able to sell it as a project. This whole idea of capacity building to create a pipeline of projects from the private sector coming in with the government and for the government to actually handle it. Because please remember, a lot of infrastructure services are necessarily handled by local arms of government, not just in India, but anywhere else. You look at healthcare, you look at education, you look at water and sanitation. End of the day, your city corporation or some equivalent is the one running it. Or a panchayat, as the case it might be in a rural area. Capacity building is needing a lot of high quality people who can help others come up, because we don't lack smart people anywhere in the world, to come up to grips with what's possible before you even get to saying, should I use green finance? Should I subsidize, not subsidize, and so on. Right now, I do believe the biggest constraint is not solely the fact that not enough money is available to resolve everything, but even the money available doesn't go because there are not enough projects in the pipeline. Dr. Patel would concur that IDFC's early years, they probably had a large corpus that was awaiting good projects, which then you actually went out and created because there were none. So number one is, where does that, in effect, burn money or grant money for capacity building? Because at the end of that process, you're still awaiting the project. There's nothing happening. Where does that money come from? I'd like the thoughts of the panelists on it. Secondly, there is an inherent bias, and I'm not going to be critical of why that bias is there, on scale of project in monetary terms. Now, I've done a lot of work in sanitation, for example, just cleaning up garbage off the streets, whether it's cities and rural areas, including handling human waste, fecal matter, and so on through sanitation, septic tanks, and this, so on and so forth. You take away our big, ugly cities, maybe Delhi and Bangalore and Bombay. Most of the other, even urban areas, there are solutions that are fairly decentralized and low cost. Now, if you go and discuss, say, I had this conversation once with a government IS officer in Gujarat. He was looking at a sanitation plan for, apart from Ahmedabad and Surat, which are the big cities, the rest of urban Gujarat. Gujarat's a fairly urbanized state, but like a lot of our urbanized states, Goa being another, it's a lot of towns with this 40, 50,000 kind of population, which is very wieldy for a pretty small scale project that's not going to be capital intensive. I think it's necessary for the funding institutions and governments as well to start thinking in terms of projects where the assessment of scale is the impact of the solution proposed rather than the money spent on the solution proposed. We've already had 3 different panelists discuss it in terms of you can aggregate many of these smaller ticket projects where, say, if I'm spending 1 crore each on 100 projects, package it as a 100 crore project, and then find a mass funder for it. The third aspect I want to talk about, which I think governments should consider, and I'm glad some of the panelists here are present, is looking at certain non-cash flow financial incentives that the government can throw to make PPP projects attractive, linked to service creation and delivery. Several years ago, I was working for a not-for-profit. We frequently have discussions at center and state government about tax exemption. You know, selling greeting cards, can we get sales tax waived? Can we get income tax waived? The typical logic of the officer making a decision was, let's assume we are spending this for a social cause. Say, typically education and health were 2 of the things that the outfit I was involved in was spending on. You should at least be spending in proportion to the exemption that you are seeking. So if you're looking at a 1 crore waiver of my tax, are you spending at least 1 crore here? I'm not even saying more than 1 crore. I can justify this, saying the government may have spent this money, we are not spending it. I believe for a lot of basic infrastructure, particularly social infrastructure, the capital investment is an investment the government would have made. And much the way in previous eras, for various reasons, government looked at tax breaks to channel investment into undeveloped regions and so on. You could look at a system by which, linked to creation of the service and performance, which can be figured out, I give tax credits relating to the private investment that are also tradable. Because very often the special purpose vehicle that gets the tax credit may not actually make the profits enough to use it. Can I sell it? And this suddenly becomes, again, a service-linked association of finance. It's no cash out of the government today. It is cash for the future. But it does bypass a lot of the politics of the era because the contract is made right now and I'm not actually signing a check. Now, there need to be ways in which government can think of, I can think of a half a dozen such other items. I know there are regulatory issues, there are various other issues, but the net effect is I don't have cash. I have a vital service linked to SDGs that make private finance, because government money is not enough, work for something that is publicly good. The last thing I'd like to talk about is that a lot of the discussion today has tended to veer a little more around the E part of ESG. And many of the things that we're discussing in social infrastructure particularly is not going to have a direct or even a beneficial impact on the E. You get more educated children who grow up and become qualified and get better jobs, they're going to consume more. The environment aspect is not great. I think Sharmila mentioned that when you are looking at environment, you have to assume there's going to be some level of destruction which will cause whatever we want it to cause. Similarly, from an environment aspect, if more people live healthily, they are probably going to be more productive and consume more. Versus right now, they're falling ill and dying. So if you look at a strictly, emission standards example, I'm just using an exaggerated contrast for this, but the fact is they may not feature in a green bond kind of circumstance because that's not what you're discussing here. I do think that the move needs to move a little away from just purely E from a point of view of SDGs and PPP. I'm not for a moment denying the importance of these other elements. To also looking at social impacts related to developmental goals and the importance of governance, the G part, because without more qualified teams to do things, nothing we want done in scale will get done at the speed that we'd like it. And the development of those teams, whether it's good teachers, whether it's good health workers, whether it's more clever financial engineers out of the banks and institutions, will be like a seed money that's needed over 3 or 4 years to get to a stage where the project pipelines fill up. And Mr. Han Kim and Anuj are overloaded because they've got more projects than the money they have, and they have to find more money for it, which I believe would be a happy problem. Those are my limited observations. Thank you.
Thank you, Prasanna. Two
two parts I would like to speak about. One is that one issue now that we are facing is that even if we are looking at education, as you said, or health, we will continue to have to be mindful of the green in it, which means that even if it is education, you'll need to train minds of young people to be aware of the fact that we require to protect environment or create a circular. So consumption itself perhaps is not bad, but if it is a consumption which is destructive, and that's why we're talking of green, circular economy, and so on. So I think those are issues that we will need to continue to be mindful of, because without being very, as was spoken to of by Anuj, that keeping the global warming below 2 degrees is going to be key for human survival, and therefore we need to have that as an underpinning of everything, including SDGs that we speak of. The other part is, and which is very important part, and which I would request Urjit to reflect on, is this. Whereas we speak of all these things, and also before we go there, let me welcome Mr. Suman Beri, who's here with us now. Mr. Beri is the vice chairman of Niti. Is it called Niti Ayog or it's just Niti? It's Niti Ayog. Of Niti Ayog. He is
not having the impact in the states that we are.
We are still struggling with the nomenclature. But let me say this, that he's a very eminent economist. He has served as Director General of NCAER in New Delhi, and he was also Chief Economist of Shell International based in The Hague. Suman has also served as a member of the Prime Minister's Economic Advisory Council, India's Statistical Commission, and Reserve Bank of India's Technical Advisory Committee on Monetary Policy. He has commented extensively in the media on economic issues, contributing a monthly column for a business newspaper. His professional writings include contributions on the political economy of reform, financial sector and banking reform, and energy trends and policy. He holds an undergraduate degree from University of Oxford and did graduate work in public policy at Princeton University. So we welcome you and thank you very much for taking time out to be here with us. So the question I was raising, and which is also perhaps something which Suman could take back with him, is this, that whereas in a fora like this, we discuss a lot of issues. Today, we are speaking about private finance in sustainable infrastructure. The overall regulatory framework or policy framework has not yet redesigned itself, as I mentioned, as green as underpinning for every activity that happens. And therefore, we may have a very separate regulation for green. We have an Environment Act and we will have an Environment Ministry looking at it. But everybody else believes it is not their concern and they will not be bothered about it. So therefore, a policy relating to, say, social justice will have no awareness of greenness into it or environmental concern into it. Or whether it is even when we're looking at the budget making, when it happens in the finance ministry, the budget itself would have one section, which may be a strong section for financing environmental related issues, but it does not permeate the entire budget exercise. At one point of time, we were talking about gender budgeting. And so gender became a separate part of it, but it did not permeate the entire budget making activity. You could make a separate budget, in the sense, show it separately, but it was not really getting into the entire ethos or philosophy of making the budget. So same is with the financial sector regulations. And so central bank, for instance, would have a lot of regulations regarding lending, priority sector lending, for instance. So you would be mindful, priority sector lending would include for poor, for agriculture, for whatever small scale, etc., etc. But it does not ever say that green projects would be, for instance, part of the priority sector lending. So that kind of awareness, what is it that one should be looking at in terms of creating that awareness so that the entire orientation of policy making or regulation making take factors into account this particular very critical aspect that we are all looking at. And because today, when the Prime Minister has gone and made his commitment on NCDs, and also NDCs, and also the net zero for 2070, there is a whole lot of now requirement for us to be looking at it, this particular issue, to be able to achieve that which the country has now committed. Urjit, would you say something on?
So, okay. So, I mean, the short answer to what Dr. Mairam said is that it's a work in progress. In part, the fragmentation, which is what you're talking about, is acknowledged in the financial sector, which from a regulatory perspective has focused more on the physical transition and regulatory risks on account of awareness and internalizing more of the direct climate risks onto the balance sheets of lenders. So that's all negative in the sense that you have to set aside more capital, which basically means lending actually comes down, not more. Now, question is that is there something to capture the positive externality to the world if more money were to go into climate change mitigation? I think that's a good question. Central bankers and most regulators and supervisors would be conservative and say if it is a positive externality, it should be acknowledged in some other way, perhaps a direct fiscal sense. But in a situation where money is becoming scarce, and where every speaker talked about it, given that we are now going to be in a different macroeconomic and monetary policy cycle in the world, whether those changes on the supervisory and regulatory sides may have to be undertaken. Now, there is already indirectly an acknowledgement that there is not enough money because the capital adequacy framework of MDBs is now a very important topic in the G20. And in a way that basically acknowledges that direct fiscal support from the richer countries is not going to be forthcoming, despite the promises that were made in 2009. Let me also speak a little bit on what you talked about in terms of guarantees. That how do you capture and account for government guarantees in PPP projects? So that in a way is a contingent liability that in case things go wrong, the government steps in, and perhaps we should consider not accounting it $1 for $1. That a guarantee of $10 is not going to be an actual liability of $10, and it might be less. So that is something that I think an entity like the IMF will have to look into, because their debt statistics are what everyone goes by in terms of the debt sustainability. And I think that an important aspect here is that the scope for governments to directly finance climate mitigation is going to be very difficult, because the because the governments are actually going to be grappling with climate adaptation costs because they are happening now. And in a way, that limited fiscal space should go there because you're creating a genuine public good, and no market can build higher seawalls, more drainage. That all these are just genuine public goods, and I think the limited fiscal space of governments has to be used for that. And I mean, overall, there is another contradiction which is quite real, and many of you, if you read between the lines, would have figured this out, is that emerging markets and perhaps even a few developed countries who shall remain unnamed have been told that from a debt sustainability viewpoint, the government should not be borrowing more or borrowing as large as they should. But the same entities tell you that, please go ahead and to the global capital markets to fund many of these things. And that obviously cannot be the case because in terms of overall debt sustainability, this does add to foreign liabilities at a national level. And the other problem in this is that, as you know, most infrastructure revenue streams are in the domestic currency. And it is actually unsafe to take on high foreign currency debt and then rely on domestic currency receipts to debt service that. So I think there is a risk there also. I'll stop there. Thank you.
Thank you, Urjit. As far as contingent liabilities is concerned, I think you made a very important point, especially when we're looking at public-private partnerships. This is a contention we had with the IMF, even when I was the finance secretary. We discussed this at length. They wanted us to put this into the liability part of the budget, and we said it is not 1 rupee to 1 rupee. In fact, it could also be the reverse of it, because after 13 years, if there is a default and I take the asset back, then the replacement cost of the asset may be much higher than what I have paid out. So to that extent, it may actually be an asset and not a liability. So therefore, calculating the liability, contingent liability part is a bit difficult on this count. But also the other part which you mentioned, we work very hard at that part, which is when you borrow from abroad, how do you save it from the exchange rate risk? And that's how the masala bonds had come out at that point of time. If you remember, in 2013, you were present there when we launched it in the IMF, the first masala bonds which were launched at that point of time. So we can also have green masala bonds, which will then be protected from the foreign exchange. Vegetarian bonds, yes, whatever. But the issue with regard to its charge on the foreign exchange reserve would continue to remain. That is for sure. Sharmila, would you like to say something on these issues? Because you were very much part of this conversation at that point.
I'll keep it brief. One is on the contingent liabilities especially for PPP projects. A tremendous amount of work has been done by the Ministry of Finance. There are guidances on this, including on precisely what Dr. Patel has mentioned, that it's always not $1 for $1. This is a very exact science, and there's maths to it. We've worked out this, we've given examples. You're free to go and look at that. And I think that should something that we should discuss with the multilateral banks, because provisioning then will reduce. And that's what's important. The second thing is when we are talking, and I think Anuj has also mentioned this, on how we look at VGF. And so this is something that you also may want to, from CERC, look at. We discussed this also earlier. VGF functioning instead of this credit enhancement fund, which hasn't taken off in the government, and I wish they would do that, because the first loss guarantee, everyone is talking about this, in climate finance, whereas the government can't finance it, if the government steps in through something like VGF or the credit enhancement fund eventually to be the first loss guarantor, that would be a tremendous crowding in tool for bringing in other finance. This is something we need to look at. It will immediately also free up the banker's perspective on lending to such projects. So this is something we need to look at.
Anuj, would you like to say something? Because you have heard this issue, and I think it was also something that you were part of when you were working with us here in India on contingent liability issue, and also the issue of how we must be looking at the crowding in of the private sector funding through something like credit enhancement fund.
Yes, absolutely. I mean, I think you've said, I think quite a lot on the contingent liability aspect, and certainly what I think is happening in some of the countries like Indonesia right now is the creation of essentially a sort of a guarantee facility from the government, but through a sort of a ring-fenced SPV structure, where actually they're looking at some of the examples from India. I think there's no doubt that having a guarantee structure for PPPs especially, and I especially think in the social sectors where there's a much greater need, and it's going to go down much further into climate adaptation now. So your coastal projects, biodiversity, mangrove restoration, all of those, they will benefit from having a government guarantee or a support mechanism, which I think sort of sits well. But perhaps if the contingent liability issue has to be addressed, then maybe using some sort of ring fence to mention on first loss. 5-6 years ago, when I was writing ADB's first green finance book, sorry for the plug for myself, but Catalyzing Green Finance, I remember we had a discussion because I was writing it around a project we were developing in China. And the whole ethos of that was, if government de-risks a project, will private capital come? And I remember we had discussions with about 5 or 6 funds, private equity and pension funds actually. And they all said, forget about concessional capital funding for a project, your classic sort of cheap money up front. Just give us an exit guarantee at year 5 or year 6 of a project, by which time we've gone through most of the risks, construction, etc. And then you can actually reduce down that guarantee after that. And we'll come in, even in a greenfield project. And I remember we had these discussions when the INVITS model was also being developed. So, there is no doubt that having a first loss or a credit enhancement approach, especially in the climate world, is very important. I think where we've also seen a challenge in this is that, especially as multilaterals talking to governments, the experience, if you like, with multilaterals, sovereign lending to governments has been much more on the cash side, right? Sort of lending upfront and using these sort of more innovative measures, because the same discussions I was having for the book with in China at the national government level, they weren't actually very joyful at sort of putting a facility together which would only provide guarantees. And therefore, maybe the way forward would be a sort of a mixed bag. And that's sort of the facility that we're suggesting in the Philippines to their national facility, which is saying, have a facility which basically is for a first loss or a guarantee structure for your underlying climate projects. Because we're angling it to a theme like climate, it becomes a little bit more receptive. But also have a certain amount of the funds which can be provided as not VGF, but perhaps as a revolving fund, a 0% loan for capex for something, as long as you also have maybe a linkage to the first loss. And maybe that's a way to incentivize some of the governments to put these facilities in place, and then on to sort of the borrowers, the local governments and the cities and the SOEs eventually. It's sort of a again, hate to use that word, but it's a blended product which one can examine when developing something. Let me stop over there.
Thank you. Actually, the issue of this exit guarantee, was addressed not just in INVETs, that when we were developing these INVETs, but also with the IDFs, the infrastructure debt funds. And unfortunately, in India, IDFs have not gone up because of there is a regulatory issue there. And we had tried to work with the RBI at that point of time. It didn't really work out in terms of the risk-rated interest rates that needed to be given instead of equated installments to the project, the PPP projects which were coming in. So these have been addressed in some way or form or the other. All that perhaps we need now is government, and perhaps NITI could look at it to see how we can repurpose them at this point of time to be able to serve the issues at hand. Thank you on that, Anuj. Now I'll open it up to the audience here. Or Elizabeth, would you like to say something at this stage? No? Okay. Hun Kim, would you like to say something? I don't know what time in Beijing now, but
yeah. So
I hope it's not sleep time.
no, it's dark, but not sleep time. So I mean, let me just put it quickly. So from MDB side, the PPP are mostly on non-sovereign private sector project finance. But even that, if you really look at it, the volume, the business is not that much, because MDB non-sovereign operation will not happen unless regulatory issue is clear. So MDB's contribution is first build the regulatory thing, and then investment will come, but still very limited. Having said that, MDB's role on the public sector side, PPP, we talk a lot and we do a lot of capacity building, but in fact, how much funding really have flowed? Yeah, even today we mentioned about some credit enhancement fund, some pool fund. So I think there are still there are new ideas to be explored, especially now when the time comes. Severe liquidity crunchy situation is here, and public sector money has play a role of the maximize the externality. That is what I said. But public sector money, the fiscal space is tight. So maybe if MDB loan can be channeled to the public sector side, PPP, then some innovative new structure is needed, and the opportunities are there. Thank you.
Thank you. Can we'll quickly take a few questions if there are, and okay, let's start from here, and then we'll come this way. Please introduce yourself.
I'm Tushar Pandey, and I'm glad to be here. Thanks, Dr. Mayaram. Always been a proponent of PPP. I am prompted to put this query come observation mainly because of Urijit's mention of the greening of the agriculture sector. And being a banker myself for many years, I have also seen PPP in the agriculture sector. What the thing is that the last, even post-pandemic, and there has been a lot of equity flow which has happened in the agriculture sector, and this has completely nothing to do with any kind of debt and all that. And subsequently, there has been development, as you would be aware, of the agtech sector and the agtech and the fintechs which are combining today. And I bring it to the climate in the context of the water sector per se. For example, agriculture's problems is water mismanagement. It is 80% of the issue, so it has got the largest ramification. While we keep discussing the integrities of, in the household management, which will contribute to 1.5%. The second point I'm making, and since Suman is also here and good to see him after a while, the institutional in agriculture system, still, it has got socio-political implications. I'm not commenting on that. But what the point is that it gets into the fact that it still remains driven at least socio-politically from the farmer's angle, whereas there is an element of all the discussion today, including the VGF, which is required, and it could lead to a situation where if people are putting in their equity money, there is certainly a case to link it up. And my final point, Rijit, I would like a comment and maybe from Suman, is that today in the case of agtech and fintechs, if you still call a bank, things are not financeable, but they are able to raise institutional equity of huge nature. In last couple of years, a lot of equity has come in. So probably can this forum, also look at that angle, maybe in the March conference. But I see this space has not been addressed adequately. You have CGIR bodies, you have, UN bodies which are focusing on the FAOs and all. But the institutional element of de-risking, that coupling element is not there. Maybe Niti Aayog itself has a large section on PPP, large section on agriculture itself. So it's just an observation and a comment, but since VGF was mentioned, I was prompted to ask this observation. Thank you.
Thank you, Tushar. Can we take a few more questions and then I'll like the panel to respond? Can you make your questions sharp and more pertinent to the discussion that we are having? I'm sure there are a lot of, yeah, Firozi.
I'm Amit Firoz. Just one or two questions. One is, how do you think that carbon credit market can actually lead to, support financing projects, whether related to green infrastructure or green operations otherwise? Because this is an incentive, some areas, it can incentivize the system. The other question is, when we are short of funds, infrastructure sector, we are dealing with infrastructure here, private financing and infrastructure. And this, there will be competition for funds from the end users of infrastructure. So the whole lot of changes will have to be made. New investments will have to be made to actually make use of the green infrastructure which is created. First, they both have to be synchronized, and perhaps a lot more fund will be required, and there'll be fight for funds in the entire system, and that is more intensive. It is it is in shortage. Third question is, who funds the closed capacity?
Would you like to conclude?
Yeah. So who funds the closed dirty capacities, maybe?
Yeah, fine. Lady there, right at the back.
Yeah. Good evening, everyone. I'm Soumya Kolla, doing my master's in public policy at Kautilya School of Public Policy, Hyderabad. So we have been talking about the role of private finance. It's true that the business is evolving and they're trying to find out solutions in terms of these operations. And responsible investors are also respecting the international standards and responding to the risk associated to this to the people and the planet. However, I would like to know, where does this investment occur in a way that the local economy in India is still, still struggling to find the possessive, what sort of capabilities and policy tools which are still challenging. So how do we address these issues in a way like, for instance, countries like India, the other challenge is, the mechanisms of having an integrated approach is a challenge. So how do local economy would like to reap the benefits from these private investments? Also, given the fact that India have this informal economy, which is sizable in proportion. So how do we address these challenges and bridge the gap? Thank you.
Thank you. Yeah, please. The last question before my question.
Yes, I.
Okay, just a minute, please go ahead.
Okay, yeah, hi, I'm Meenal. I was just very two short.
Can you go back into a second round?
Yeah.
A little time. Yeah.
Just
okay.
very quickly. Some comments on social stock exchange in the context of, the regulation, a lot of discussion happening in our country now. Also in terms of supply side regulatory as well as preparedness, when it comes to investment, the whole part of preparedness. So some comment from esteemed panelists on that. And the second question is, maybe the private enterprise will try to find out the supply side, the money might still come. But do you think that operation and maintenance is still an unresolved kind of puzzle challenge in all the projects.
Thank you.
My name is Neha Kumar, and I head the South Asia Program for Climate Bonds Initiative. I have one observation related to which is my question. The observation is that it seems to me, now that I'm actually living it, sitting in this room, that one part of the government doesn't seem to be talking to the other part of the government. And it not only is about the design of policies, it's also about the implementation and everything that comes with the rest of it. To give you an example, Shamila, you talked about we need a taxonomy. Ministry of Finance has actually anchored the whole process. That report is ready with the Ministry of Finance for last 9 months. I say this because I'm a part of the core working group on taxonomy development and the lead author of that report. And I also bring it to the attention of Mr. Berry because the co-chair of our working group is Niti Aayog and Ministry of Environment and Forest. Why I bring this to the attention of this house is that it is exactly the thing that India can come up in its G20 presidency, where it is actually saying that, it is taking the leadership position. It will channel credible investments. It'll make things much more clear. So that is one thing, The second thing is, I think out of all of this, out of the 2 years of effort that we put in, it is the Reserve Bank of India which has come out with a discussion paper on climate risk and sustainable finance, having waited actually in order for taxonomy to come out, because it is actually considering to use a taxonomy to relook at PSL. Right? So there are a lot of things which are not really going in conjunction. And my plea, I think, would be to Mr. Suman Berry. The second thing is, you talked about green masala bond. We have issuances. IREDA has issued green masala bond. The question is, then how do you scale up? And I think one of the things is, while we do definitely need international capital, simply because there is no investor demand in the domestic market, simply because our capital markets, for reasons that they are shallow, have really not been able to capture that market. However, I have to say that green bonds as an asset class within a shallow capital market is still growing. We are 25 billion worth of green bonds till June 2022. So there is a lot of things which are happening. There somehow requires a much more concerted effort from all our parts and arms of the government with private sector participation to actually take a few things forward. IFSCA is doing a lot, but in a sort of a microcosm of these things to channel international. My question, I think, probably to Dr. Urijit Patel and also to Mr. Mayaram would be, how do we create dedicated green capital pool within the country to unlock and to differentiate and to reward the market in terms of that you have a demand for green projects, right? This could be done through regulatory carve-outs, but this could also be done through, with the help of AIIBs and other kind of multilateral banks, sometimes creating a sovereign-linked debt fund or something like that, where NIIF did it for the equity kind of things. The infrastructure debt fund within NIIF is now being looked at to promote debt funding into infrastructure. ASEAN infrastructure is part of that. There is so much happening in this country, but we are not talking to each other. I mean, I could go on and on each of the things that each one of you so elaborately explained, but I think the time has come to really take it to the next level, to make it public, to make these conversations really, really inclusive, public, and let the government arms talk to each other. We are ready. Private sector is ready. Private sector, I talk to the financial sector, I talk to the developers, they are ready. They want clear, explicit policy support and signal. It is good to have stated our 2070 net zero target, but we don't have anything at the back of it. We don't have sectoral transition pathways. I'm told there are different organizations which are working at it. There is no way to know who's working at it.
Thank you. I think that's very pointed. And
Yeah,
to the last question.
Last question, let me try and make it as short as possible. It might be telegraphic, but I suppose you would follow what I'm saying. And the other day, the ICRIER held their 14th G20 conference where Suman also spoke. Interestingly, Nirmala reminded us, our finance minister, that this is in the context of the source of financing, etc., which Urjit has spoken about and others have also. A lot of collateral issues have come up in this discussion here. And let me focus on the central issue of raising money. And that is what was a big challenge before. Maybe we've had this discussion since the Earth Summit in '92. And you find that the West will always continuously fail in their promises. There's no point relying upon that. Now, the current juncture is fortunately a near consensus for a global minimum alternate tax on corporates of 15%, which Nirmala ji said we're going to pursue at G20 to give it shape. So far, it is still in the discussion stage. And there is, G7 has also agreed, but it's not yet been moved forward. And that is one way as to how to raise government revenues, which are very important, even for success for PPP projects, for this reason that has already been explained. The point what I made even in that event was, why are we not thinking of reigniting the Tobin tax debate? The Tobin tax was a very simple instrument which did not tax any treasury, but it taxed only financial transactions happening globally among corporates. We need to revisit that. Thank you.
Thank you. What I'm going to do now is, because we've run out of time, we have taken all the questions and I'm going to run them through the panelists and we will put the answers in the proceedings that we issue so that we can save time on that. So I would now request the launch of the book that we have on social sector PPPs. Now may I request Mr. Suman Berry to give his address.
May I give it from here?
Yeah, sure.
Okay. Let me start by thanking Cirque and Arvind for offering me this platform. It's a particular pleasure because I returned to India from my stint at the World Bank in 2001, and I think I'm right in saying that both Urjit and Pradeep have been friends literally since I got off the plane. So to be at an event organized by CUTS and in the presence of Urjit is a great a pleasure and indeed an honor. Now, I'm innocent of the discussion that's happened up till now, except as picked up in the last half an hour. I was asked to give a keynote address on infrastructure development for SD on the topic of the conference, which I took at face value, infrastructure development for SDGs, role of private finance. What I've heard has been much more about the plumbing of finance, of PPPs, etc. I think I think it's appropriate for somebody giving a keynote address to rise a little bit above that, and that's what I plan to do, is just structure at least my own thinking on the sets of issues that this raises. I had been assigned half an hour, but I'd like to keep it to about 20 minutes so that there's time for questions if that's warranted. Okay, so let's just talk about this particular moment, literally November the 5th. We are on the eve, as Pradeep mentioned, of India's G20 presidency. We are midway through the period of the SDGs from 2015 to 2030. We are at the beginning of COP 27, and not unimportant to all this, we are on the eve of the US midterm elections, which are likely to have quite a bit of impact on the overall kind of global environment towards sustainability, maybe even COP itself. Okay, so I saw, I heard in my brief presence here a lot of reference to the role Niti Aayog has been playing and could play, and I'll certainly keep that in mind. But why I accepted to be here is because Niti Aayog is, as government puts it, the nodal agency for the SDGs. So I'll just talk a little bit about the SDGs, which of course are featured in the back of the flyer, and then link it up with the G20, link it up with infrastructure development, and finally link it up with private finance. So that'd be the broad logical structure of what I intend to say. So I think there's an issue I'd like to raise about the SDGs, and then there's an issue about Niti and the SDGs, which is relevant since Arvind is here. So I think we must remember, because there's been a kind of absolutism about mitigation above all else, that the SDGs, which do represent, and it's difficult to remember this 7 years later, given how polarized the world is, they are a global consensus on the development agenda signed up to by whatever it is, 180 countries. It's worth reflecting on what an extraordinary achievement that is, given the great variety of political regimes. I don't think we could achieve that today, but it was achieved, and we should cherish it, particularly as it happened in the first year of Prime Minister Modi's first term, happened in the same year as the Paris COP, and is monitored both globally and by Niti at the national level. And it is in its construction a device or a framework that embeds sustainability in development. And I do think as we proceed to the G20, as we take our case to COP, irrespective of views on what the G7 or what the rich countries can be expected to do or not do, my own view is that holding on to the notion that sustainability is a part of a development agenda rather than something, as it were, self-contained or captured only by mitigation, is a very important dimension of the SDGs. And I believe, and I said so at the CREA conference, India should fight for that throughout its G20 year. Now, the SDGs are universal. The G20, by definition, is a self-appointed group of 20 countries. It therefore lacks the legitimacy of of the SDGs. But on the other hand, the development working group of the G20 has formal links with the SDGs, and the India's G20 and past G20s have attempted to provide momentum in various ways to the SDGs. And I don't know how many of you follow what the Secretary General has to say. He actually happened to be in Gujarat just 2 weeks ago, and he has been astonishingly blunt on, as it were, the failure of the global community, but particularly the rich countries, to, as it were, do their share in maintaining progress on the SDGs in this in these very difficult and challenging times. And so, in this sequence of 4 presidencies from the South, Indonesia, India, Brazil, and South Africa, bringing energy back to the SDGs and using multiple G20 instruments, working groups, to, as it were, draw attention to the importance of the SDGs, I believe should be, and I think is, on the basis of preliminary work, a theme of the India's G20. Now, the next element in the title is infrastructure development. And as you know, India has a national infrastructure pipeline. My understanding is that much of that is what one might call hard infrastructure, sort of transportation, energy. But it was my understanding that some of the discussion today was really about social infrastructure as well. I'm actually a little ignorant about whether that's included in the national infrastructure pipeline or not. There are issues that social infrastructure raises. Actually, I should have made one more point with respect to the SDGs before I move on to infrastructure development, if you will permit me, which is that in addition, and as part of what NITI does in preparing India's report card annually since 2017, is it has been very successful in localization of the SDG framework down to the level of the states. States, in their turn, have taken it down to the level of districts. Why am I saying this? I'm saying this because I understand from Deep that Arvind has a very important role to play in thinking about these issues in Rajasthan. And it is the case that a very important mandate of Niti Aayog, carried over, of course, from its predecessor, the Planning Commission, is to work with the states. And therefore, I'm not sure how much of the earlier discussion dealt with the challenges of taking many of these issues down to the state level. But I do think that it's a truism, but given how important the states are in both regulation and in investment, that infrastructure development, particularly if we're talking about sustainable infrastructure and resilient infrastructure, the lead is going to lie as much in the states as the center. And we've heard from people who were involved with setting out the framework in previous governments at the national level. But I personally don't have a very clear view how well that framework has been adopted by the states. But maybe we could have a brief discussion on that. And I'm sure with Arvind and Pradeep in Rajasthan, that there probably is a lot of thinking at the state level in Rajasthan about these issues. What do I mean by these issues? The issues are A, financing infrastructure, B, getting the private sector into financing infrastructure, and C, getting the private sector into financing sustainable and therefore possibly more costly infrastructure than, as it were, plain vanilla infrastructure. And there's clearly a regulatory dimension, and then there is also an enhancement dimension or a credit enhancement dimension. Now, as we unpack those issues, I think it's worth asking ourselves, as it were, both four questions. First, why the private sector? And second, how the private sector? Third, domestic financing issues. And fourth, cross-border financing issues. And I've heard all of these come up even in my brief time on the dais. And the issue of why private sector, I think, was, as it were, raised, whether it was satisfactorily intellectually addressed, I would think in UPA 1 was not entirely clear to me. I don't think that a paucity of fiscal resources is an adequate reason for wanting to bring in the private sector. And indeed, a comment that was made at that time, which I think remains true, is that one of the things that you get by bringing in the private sector is actually a lot more public scrutiny. I mean, stuff that's done on force account and done by the public sector, somehow all kinds of inefficiencies. It's kind of consenting adults game between, the NTPCs of the world and the state electricity boards, but get the private sector in, as we successfully did with merchant power, then, there's much more transparency and visibility. So, and I'm contrasting this with, the elementary theory of public finance, which basically suggests that a public good with a public externality should be financed out of general tax revenues, should not be financed unless you've got a very good, as it were, capture mechanism, a revenue capture mechanism, probably should not be financed by the private sector. And so I don't know how far that debate has actually progressed on what our motives really are for bringing the private sector into infrastructure. To my knowledge, it remains, as it were, the fiscal arguments, and I think the fiscal arguments from the pure theory of public finance are actually relatively weak arguments. And this would probably apply at the state level even more than at the center. Okay, so accepting that there is ambiguity about why the private sector, the question then becomes how the private sector. And we've heard some discussion, I've heard some discussion about public-private partnerships and viability gap funding, various models that have been tried. I won't provide an assessment of what has succeeded and what has not succeeded. What I can say is that the first phase of PPPs in India seems to have left something of a bad taste in people's mouths. And so I'm not entirely clear what the fix on that has been. And again, I'm talking of the visible projects at the national level. There may be even more, difficulties at the state level. Let me also note that this is not an India-specific problem. So I happened to work at the World Bank on Latin America when Brazil, Mexico, Colombia decided to go for concessions, particularly in hard infrastructure, primarily power and highways. And their experience was no better because of, problems with gaming the bidding, expecting to renegotiate, genuine problems on traffic forecasts, etc. So when you combine, as it were, the shaky case for bringing the private sector into investments with large externalities, with, as it were, the infirmities in the regulatory framework and the issues connected with transparency in bidding, not transparency, but genuine risks in bidding these things out. I'm not saying these are insoluble. I mean, they are solved by the rich countries, but I think, I would think that SATs and CERT, etc., need to clarify what this debate is. Okay, now coming to let's go beyond that and talk about the domestic cross-border issue as that arises, particularly with respect to green financing. And here, the issue is, by the way, I'm not wanting to be nihilistic. I'm just wanting to set out, as I think a keynote address should, what the conceptual issues are, and then it's for others to take those forward. So let's talk about the domestic financing. And here, again, it's a question of debt versus equity. Now, it's well, the first point, which is both a domestic and a cross-border point, is that there doesn't seem to be a big problem in financing private investment in green infrastructure in the advanced economies. I'm not aware that offshore wind or solar or whatever has difficulty in attracting financing in the UK, Germany, or maybe even in, and certainly, nor in China. I don't have a good answer to why that is so, whether it's a question of the depth of the capital markets, the stability of the tariff regime, the stability of the regulatory structure. I understand that, for example, the efforts of certain states to renegotiate PPAs that were gaining momentum as the cost of renewable power went down. I'm told that that issue has been now more or less solved. But what and there's also the discussion, or there's also the issue of whether financial intermediaries exist to, as Neha was saying, to bundle, as it were, a series of these projects together to meet the appetite for green financing or for green projects in wholesale markets. So I'm saying that there is a set of issues on the availability of equity finance and debt finance in the domestic markets for infrastructure. Now, one of the schemes that NITI has come up with, which is somewhat different from what I was hearing about first loss and first loss guarantees, etc., is the issue of asset monetization, where the initial promoter is in the public sector and where having taken on the completion risk and the construction risk, then that is offered to the private sector so that the draft on public funds, so that the demand for public funds can be reduced or can be replenished. Because I'm almost at the 20-minute mark, let me just make 2 points about cross-border, and then if there's an interest, we could have a discussion. On cross-border, I think the two important issues are the cost of capital and something I see very little discussed, which is what the economists, development economists, call the so-called absorption problem. I'll deal with the second of those first, and then talk about the cost of capital, which is terribly important, both of which are important. Now, when, say, the Marshall Plan, or say before private capital markets got into the act, external financing was largely a matter of foreign aid, as it was in India's case, I would say, up to the 1980s from independence. And then, the issue became, so how does an economy absorb foreign finance? And simple macroeconomics would tell you it can only absorb foreign finance if the current account is allowed to widen. Okay? So let's assume you've got investment rate of 30% and a savings rate of 28%. The difference between those is the current account deficit. If you actually want to absorb real resources from abroad, that current account deficit has to widen. Why is that relevant now? Because people are talking about getting more money from abroad to finance the investment boom that green projects represent. But I haven't heard a convincing explanation of how skittish global capital markets can be persuaded, as they used to, that it's reasonable for an India to run a current account deficit of 3% of GDP rather than 2% of GDP. What we're seeing is just the opposite. What we're seeing is risk on, risk off, the dollar goes up, money crowds out, there's a compression of the current account that's required in order to make sure that we don't run into a financing gap. So I think that the issue of expanded cross-border flows, even private, forget about public, will require a global financial architecture that is benign towards a widening of current account deficits. And I don't see that in the global financial architecture at the moment. This is an issue, I believe, that India should bring to the G20, because it's a relevant topic for something called the International Financial Architecture Working Group. This may be a little geeky. I can take questions later, but the second is the cost of capital, and this is where the multilateral development banks come into it, because given where most emerging and developing economies, let's talk about emerging markets, are post-pandemic, most of them already have high debt GDP ratios. And if you are expecting that they will finance additional investment over and above their domestic savings capabilities, even including improvements in domestic taxation, through borrowing on private capital markets, that doesn't compute. I don't think that sustainable projects on the whole can meet hurdle rates of return of 10%, which is in effect, risk adjusted what the private markets are going to require. And that is why so much attention is being now directed to the multilateral development bank's balance sheet, and whether, without, as it were, asking for more capital, the balance sheets of the multilateral development banks, Arvind is fully familiar with this stuff, can be sweated harder in order, using innovative instruments like first loss guarantees, etc., to reduce the cost of capital for eligible projects. So I'll stop there. I would just say that, there's a lot to be done on the plumbing, but from time to time, it's worth going back to first principles. And I didn't mean to be nihilistic, but I just wanted to say that these are debates India's been having for 20 years, and we should, in a sense, enrich the debates and learn from those who went before. Thanks.
Thank you very much. I think it's a very, very thought-provoking keynote, and I think that is what we were hoping we will get from you. We got something better. So thank you very much for that. I would, before I open up for others, I would just like to make 3 observations or to what you said. I think the debate on why and how on PPPs or private finance in public infrastructure has more or less been settled. And I'll tell you the reason why. On the why side, finance is whereas most governments started off by looking at as a fiscal gap funding. But I think over a period of time, we were able to establish, and the framework that we established at the national level was actually taken down to the state level. And at that point of time, I was joint secretary, and later I became, Sharmila was my director, and then I became, when I became secretary, she became the joint secretary. We did a lot of work on taking this framework to the states. And we had a very large TA through which I think in 21 states we had put PPP experts, which we drew at a national level from the market, which were paid by the TA by Government of India on secondment to the state governments to help them develop their framework. So, and then there was a whole toolkit which was prepared for capacity building, which now has been adopted by the LBSNA in Missouri through their master trainers and so on. And it was taken to all the states in capacity building and training. A lot of work was done on that count. But it was also on account of the fact that, you see, the problem is in public finance, the budget cycle is 1 year and the government cycle is 5 years. And therefore it is very difficult to budget for maintenance of the projects over a long period of time or over its life cycle. And therefore we find that whereas revenue expenditure on maintenance is not treated as good or quality expenditure, whereas capital expenditure is quality expenditure. Now we are at the state level. In fact, we are working on a project on what is quality expenditure. And this we will share with you when we have completed this work. But we are working on what is quality public infrastructure. Now, the problem is that when you have revenue expenditure not treated in that manner, therefore the money for maintenance continues to shrink because the money is only that much. And if you are creating new infrastructure assets, maintenance of older ones and then they fall to seat. And therefore, there is this whole problem of then having to restart or the infrastructure not be productive. Through public-private partnerships, we discovered that you can actually do a life cycle costing of it. And these are long 25, 30-year costing. So it is built into the project. And therefore, once you have signed off on it, agnostic to which political party comes, if the contract holds, then that infrastructure will be maintained at a particular level of efficiency for the entire life cycle. I think that is the greatest contribution that private investment does to infrastructure, and which includes social infrastructure, green infrastructure, whatever you may call it. And how, of course, we have worked out on all these aspects of how public procurement should be done for PPPs. Now it's a whole literature on it. Much of it was driven by Finance Ministry, and we have a lot of it there, including what the Planning Commission did in the case of model concession agreements and so on. So that kind of work went into it. As far as the experience with PPPs also is concerned, I would like to make a small point here. That out of about 15,000 or odd PPPs, the ones which really fell into disuse were not more than 100. And the rest of them have been very successful. And they're on the ground and working. But the ones which went bad were the high-profile ones. And they were the ones which really got into trouble. We also must remember that there always is a learning curve. So however well you can conceive, but when you're working with something, then you have to keep improving on it. So there was a lot of criticism of, for instance, Delhi Airport PPP. But that was the first one that we did, and therefore there were bound to be problems with it. And over a period of time, you learned with it, and then you make it better. And then the other airports went differently. So there has been a learning curve also. And I think government got singed too quickly because governments by nature are very averse to criticism. And once a little criticism came into it, then they stepped back. And I think it's important that we realize now that there's no way we can do, whether it is SDGs or our green commitments, etc., without bringing private sector back into it in a big way. Like I said, not just for finance, but also for efficient delivery. And that, I think, is more critical than even finance, as you have mentioned. I'll stop here and I'll open any questions you will have.
I stand corrected.
Any questions you'll have here? Or from the panel also, those who have joined us online, if there are any observations or yes, please. Please introduce yourself.
Sir, I'm Nishit Srivastava. I work with a bilateral bank. My only question is, I mean, it's KfW, it's a German development bank. So my question is that, sir, when we are talking about different stakeholders, I mean, there was a similar question also raised by a representative before. Every stakeholder has its own priorities and there are some timelines. So when we talk about government has their 5-year horizon. While the private sector, when they're investing in any project, they have their different horizons, priorities. So sometimes, or most of the times, I have always seen in infrastructure projects that this marriage doesn't happen. And that is one of the key elements why most of the times these things fails off. And especially in India, especially in politics, things keep on changing at a very rapid pace. So do we have any kind of an answer or your views onto it? How do you see?
Look, I think the sad truth is across big institutions anyway, departments that are independently big end up not talking. From the point of, let me just take infrastructure specifically, okay? And from the point of view was, by the time you get to a funding stage, which one of our colleagues here, the lady had made the point of why aren't people talking about the funding mechanisms? When cooking up the project, the nature of project requires you to interface across many institutions. We do it in general pretty terribly in India, let me be honest. Okay, you are aware of it, most of us are aware of it. Now, as it transpires, it's pretty much a global phenomenon. You take away countries like maybe Germany, which has a very time-bound system to saying yes or no, which is over a 2 or 3 year time frame, depending on whether it's local or a national cross-regional infrastructure project. They reach a point where they say, yes, the project is on, or no, let's dump it. Vis-a-vis whatever the developmental, environmental, social priorities are. So no one's left hanging forever trying to cook a project up. That's part A. Part B, I've recently experienced this by strange circumstance with at least one big financial institution in India with banking and other sort of retail services, and another in telecom. Now, I hate to say this, but the department's not talking to each other. Seems to be a fact of life. Where in this case, as a consumer, I face the consequences of sloppiness because it's a big institution. Not every arm works in scratch. Institutional structures don't allow talking to each other. And I'm not speaking about just a bad employee, but a system where your credit card application does not speak to your savings bank application is part of banks that get awards for their tech savviness in India. Right now, can we do better? Of course.
So I'll stop you here because we'll run out of time. My request is please address questions now to Mr. Berry on what he has spoken, because the general question, as we discussed earlier, we have already taken their questions and we will answer them in our listing. But now I request you to ask questions to Mr. Berry on what he has spoken, which I think is very thought-provoking. And I think we need to reflect on what he has said. Neha.
Yeah. So just a clarification one that you said, is social infrastructure included in national infrastructure pipeline? It is. Education, health, etc., is very much part of this, and I think some projects have also gotten money to be run. The question that I have, then the second point that you had made is what is happening at the level of states in terms of financing SDGs and infrastructure related to SDGs. So I've had the opportunity to be in conversation in more than one state, including Rajasthan. The other one is Haryana and Tamil Nadu, etc. There are 2 or 3 things, and my question is directed to you as well as to Dr. Patel. So when you're talking about raising private financing through these innovative mechanisms, etc., you at the state level, there are one barrier is that if the state government doesn't want to go straight to the market simply because they are not credit rated, right? Not a single state government has a credit rating, and there is a first mover disadvantage, which most of the states told us. Why should they have to go through that scrutiny and that rating, which may give them which may actually put them, say, in relation to Haryana and Punjab, worse off than Punjab, but Punjab hasn't gotten a credit rating, right? So government directly going to the market has that one barrier. Second is, can the state development loans, which are market borrowings especially, can they be in a way green SDLs, which means to say that there are assets on the state books, which can be refinanced if you were to tag them, whether they were green or not. For example, you could have reservoir systems and everything. So adaptation and resilience, all of that could also be part of now a new thematic SDL, which is green SDL. That's just one question, that who gives that label? Is the state allowed to give that label because it is using its SDLs for green projects? Or will a central bank say, oh no, here I come, it is through me that I'm borrowing from the market. So what you call an SDL, you can't call SDL anything, or you can call SDL something, so that was my question. The other is about the state-backed entities and SPVs that the states can create, which can both tap the domestic market as well as the international market. But the governance in state level, the very many aspects which actually make state institutions not that attractive for market investors, whether they are domestic or they are international. We have seen that in the power sector. Nobody really wants to touch a state with a barge pole because of, I think, a whole lot of governance issues at the state level that the states are facing. So these were just a couple of observations.
Firstly, your observation on the unwillingness of state governments to be credit rated is fascinating. I mean, I knew that up till now, most borrowing was club borrowing through the RBI, but the notion that that voluntarily states could subject themselves to a rating process, I think is one that's worth playing with. In this whole discussion about freebies and this and that. I mean, it's an antidote to that. But my question to Urjit would be the following: if if a bank like the AIIB declares that it is intending to allocate 50% of its portfolio to sustainable lending, does that, in a sense, provide a route by which, as it were, beneficiaries of your lending could qualify for some kind of a green label? I mean, what would be the criteria that you would use? Because this, in a sense, is responsive to your question, right? That
well, that may be possible. I think it's easier in the case of AIIB saying that, okay, I have this lending and possibly you can access that that green label. But I think it's much more sort of unclear within the domestic market borrowing space for states, which is basically managed by RBI through SDLs. Can they be labeled green, and can then the domestic market differentiate or give a preference over that? I think it's a lot. What I'm trying to say is it is the labeling which makes a difference, a lot of difference, even in terms of attracting institutional investors into, they do already, but the labeling
my
mechanisms.
point was that if, as it were, criteria were developed by the MDBs on what part of a state's investment program they are willing, on the basis of their own criteria, maybe not a government taxonomy, to qualify as green, there may be kind of spread effects from that methodology. That's what I had in mind. Urjit, do you have thoughts?
Thank you, Mr. Berry.
No, I mean,
and you've been at the RBI.
I think the issue is that it's an issue that I touched upon, that it's important that if the green bond market has to have credibility, it should be very clear who is funding what, not only in terms of the labeling, but the actual investment. So it has to be project specific.
Precisely.
I don't think you can have an SDL, which is SDL is a government bill, government borrowing by another name. So I don't think that would happen.
I think she was saying exactly that. I think she was saying that SDL is an instrument which, what she's saying is that you have a part of SDL designed which can then fund project specific, which fits in with the qualification of that SDL.
Yes.
Project itself should
okay.
That could happen. That's probably happening in terms of an entity, even a domestic bank, let alone an MDB, recognizing a particular project in a state as a green project. So I don't think this is. I don't think. She wanted it to be part of a market borrowing program, and a part of which is deemed, because if you borrow, you have worked in the finance ministry, so I don't need. The funds are fungible, right? So if this is coming as an SDL, the end use has to be very specific.
Maybe we can take this offline, because there are certain ideas that we've been working with. Yes.
Any other observation? Anyone else? Okay. So thank you. I think this has been very rich and very thought-provoking session today. We have traveled over a very vast territory and diverse territory, which is perhaps that is how the lay of the land is when we look at SDGs or green finance and things of that kind. And so out of this, possibly we will have some new ideas germinating and coming out, and we'll see how many of these issues which have come up today, we can try and address them in our papers or in the research work that we do, and which we will share with you. In fact, when you were talking about the Rajasthan thing, we have already concluded. Abhishek is here, my colleague who is working with me on this. We have already done 9 papers, policy papers, which we will send to you, which are a little forward-looking in terms of reorienting economies and their different aspects, including informal economy. And now we are looking at two of the projects we're doing are on related to green, and one is on quality of infrastructure.
This is what the
At
planning
the
board?
Rajasthan, it's not a planning board, it's called Rajasthan Economic Transformation Council. That's where we're working on this. Thank you. I'll request Nidhi to do a vote of that.
Hi, good evening, everyone. Without taking any more of your time, I, Nidhi Maheshwari, on behalf of CERC, would like to extend my sincere thanks to all the speakers for sharing their opinions today. And I would also like to pass my warm thanks to all the audience for their significant presence in this meeting, in this discussion. And I specifically want to thank our guest of honor, Dr. Urjit Patel, and our chief guest, Sri Soman Berry, for their vital appearance. As a token of gratitude from CERC, I request my colleague Vivek to please present saplings to these speakers.
And I think you'll have to send virtual plants to our speakers online. Thank you.
Thank you, Vivek. May I request you all to please join us now for the high tea? Thank you.